Welcome, 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 everybody. A very special welcome to all the new joinees whom we are meeting for the first time. By the way, can we get an idea of how many of you are new, that is not our subscribers? If you can please respond to this poll so that I would get a good idea of the topics that will be, repetitive to you and the topics that you're already familiar with. Okay, that's good. So we have a good distribution. That's fantastic. All right, so let's just give it a minute or so for the others to join in. We already have more than 50 people, so that's fantastic. And we have quite a few new people. Awesome. All righty. Okay, guys, so are you all excited to be here? Type excited if you're excited to learn about some hidden secrets of long-term investing, stuff that we normally don't spend much time talking about. All right, awesome. Awesome. So a lot of people are excited. That's good to know. I'm also very excited to share these stuff. Fantastic. Okay. Oh, guys, I really appreciate your being here on this Thursday evening. This is not a regular tutorial, and I know you had other things to do, but you have chosen to be here. So on behalf of the MoneyWiseSmart team, a very sincere thanks to you all. And when I say MoneyWiseSmart team, it's now more than myself and Pandyan. We just have our new person who will be joining us pretty soon. I'll soon introduce him in the group. Guys, we promise to offer the best value for your time over the next couple of hours, 2.5 hours. However, you will only derive full value from this session if you attend till the very end, because we are going to share a lot of secrets that are like a set of pearls on a string that is not knotted at the end. And the best pearl, which is an eye-opening case study, I will keep for the very end. And only then the string will be knotted. So unless you watch till the very end, your pearls will fall off the string. Now, there are some valuable surprises at the end. However, if you are multitasking, if you have other things to take care of, or if you're just passing by for some time to just briefly check out what's going on here, you might as well log out now, because you're definitely not going to benefit from this session at all. You know, the topics are linked, and that's the reason why I highly encourage you to be there till the end. So if you are committed to be with us till the end, type TTE in the chat, that is till the end, so that I know how many of you are really committed. Okay, excellent. Jovin, Apurva, Patrick, Derek, Kenny, Sailesh, Jonathan, Connor. Awesome, awesome. So, you know, that also motivates us to give you the maximum value. And guys, I promise you that I will address all your questions, but I request you to keep your questions for the very end. We will have a dedicated Q&A session. Now, this is what we are going to learn in this session. We are going to start with my business partner, Fan Liang, present an overview of a business which we researched in great depth. And interestingly, it happens to be available at a large discount right now. So this is our gift to you, especially all those who are not our subscribers. You will get a glimpse of the kind of research that we do. But keep in mind that this is not a recommendation. We are just sharing our research process, and this is just pure fact-based research. This is not a recommendation. So please do your own due diligence. I will then dive into the not so sexy secrets of long-term investing. most of us are either totally unaware of these secrets or pay very little attention to them. I will also share with you some of our own results that we have been able to achieve following the exact same principles that we will cover today. And I will share some numerical case studies in a worksheet. I call them the secrets case study. Now, one or two of them our subscribers of option series might be familiar with, because I have covered some of them in the tutorials, but several others are there. So you will definitely see something new. And I will also show you how you can significantly boost your long-term results beyond your wildest imagination, just by understanding these principles and never forgetting them. And for those of you who are committed to take action, to take your learning further, this I'm talking about the non-subscribers, we also have a very attractive offer for you right at the end. So without further ado, let me pass the mic to Fanya. Fanya, take it away.
Yep, sounds good. Thanks, Rupam. Let me just quickly share my screen. Can everyone see my screen?
Yes.
Cool, sounds good. So let's start. So welcome everyone. As Rupam mentioned, we're having an exciting session today. And before I start, let me just quickly introduce who we are for those who are not familiar with us yet. I am Fan Liang, and Rupam and I co-founded MoneyWiseSmart together at the start of 2020, but we have both been investing for many years before that. Before starting MoneyWiseSmart, I was a director in a listed American consulting firm dealing with corporate finance and disputes issue. So I was doing a lot of valuations of companies and assets in both the Singapore and Melbourne offices. Rupam used to be in the executive management team of a FTSE 100 online gaming company listed in London, and he was responsible for his largest business unit, managing revenues of over $1 billion. He left the job more than 13 years ago and has been a full-time investor since. So Rupam and I actually met in Singapore several years back due to our common interest in investing. And we have been researching good companies to own, like JD.com, iFast, Bank OZK, etc., together with a few other investors for a long time. I still remember the day when Rupam and I met for a beer at Tanjong Pagar. I think it's at Duxton, where we were discussing how can we share our knowledge and experiences in investing with the public so that more people can benefit from them and also avoid the painful mistakes that we have made. So we decided to team up and create something that we would ourselves gladly pay for. And so MoneyWiseSmart was born with the few different courses that we have now and a strong investing community that we have built up over the years. So over time, our community has grown far beyond what we had expected earlier. And we are thankful to be able to talk about investing with everyone, with you all, and help everyone compound wealth for the long term. So now let's start the first part of today's session with an amazing business that we have been researching since last year. So question here, does anyone here know this company? Have anyone heard of it? If you have heard of it, you can type yes in the chat. If not, then no in the chat. And by the way, as Rupam mentioned, this is by no means any investment recommendations. We are just going to show you our investing process so that you can use it for your own investment journey. And I see many yeses and I see some of you heavily vested. So that's good to know. For those who do know, you'll get to hear about them today. So this company is StoneCo, a technology company that Berkshire Hathaway had invested in a few years back in 2018. Although the decision was not made by Warren Buffett, but by Todd Combs, one of the two main fund managers at Berkshire Hathaway, there must be something that they see in StoneCo for them to buy this Brazilian technology company. So we have researched this company for many months, and there are a lot to say about this business. But today, in the interest of time, we will just talk about some key points of the business, including how we look at the valuation of the company later. And there are more details about this company in our Multibagger Research Series program for those who are interested to know more. So let's dig in. So basically, StoneCo is a one-stop shop partner for small and medium businesses, or SMBs in short, in Brazil. So imagine today you want to start a small business in Brazil, maybe say a restaurant or a retail shop selling clothes. So you will need to set up your payment system to accept payments in store with a point of sales or POS device, and maybe online using payment gateways. Then you also need banking and credit services, and you'll need many different software to run your business. StoneCo basically does all this for you, providing you with high quality integrated solutions so that you don't have to deal with many different vendors for the different needs and try to integrate all these solutions yourself, which can be a pain. So in a way, it's sort of like Square for those of you who know about Square in the US. And StoneCo is focused on helping the SMB customers to manage their businesses easily on various aspects, and then grow and succeed. Because when their customers grow, StoneCo would get to earn more revenue too. So it's a win-win for both parties. So why look at Brazil, a developing country with more country risk? What makes the payments industry in Brazil interesting is that the industry has been dominated by a few inefficient incumbent banks for many years. But the government has decided to open up the market for more competition to improve the quality of service since 2010, which provides a lot of opportunities for the more efficient modern players like StoneCo to grow very fast by easily taking market shares away from these inefficient traditional banks, which have been underserving the customers and also overcharging them. For example, here you can see a commercial by a competitor where they were saying just opening a bank account to get your business going can take a few weeks or even months with the traditional banks. And also you get very bad customer service. And these painful experiences give the merchants in Brazil a lot of reasons to want to switch to StoneCo. One of StoneCo's co-founder, this guy, Andre Street, he saw these problems faced by the merchants and decided that he wanted to build from scratch a technology platform that integrates all the solutions needed by the merchants, and that is going to be 10 times better than the existing competitors. And one of the things that makes StoneCo special and has high customer satisfaction is their proprietary go-to-market business model, where they set up local hubs in each of the cities or neighborhoods in Brazil so that they are very close to the customers and can visit the customers to provide services and support within minutes or hours, which makes the customers happy. And they are also very customer-centric, always thinking about their customers and working to provide the best solutions and also values to their customers. On its business strategy, StoneCo has a ABC plus software strategy, where A stands for acquiring, so providing payment services like the POS device that you see here, and fast and reliable payments processing. And then B for convenient digital banking solutions, and C for credit solutions, where because StoneCo has so much data from the payments processing side and also the software side, they understand the customer's cash flow very well and can make quick informed decisions on how much to lend while ensuring that they can collect it back fast and good. And StoneCo has various software solutions too, like enterprise resource planning, ERP software, CRM software, online booking software, accounting software, social media management software, etc. for the various verticals. So it helps to solve all these problems faced by the merchants. And because StoneCo focuses a lot on customer service, and because they can provide this seamless integrated set of solutions for the different merchants' needs, StoneCo get a very high net promoter score, or NPS in short, of 65 versus just 4 for the traditional competitors. So you can see how huge the difference is. And for those of you who haven't heard of NPS, the NPS basically indicates a customer's willingness to promote the company's services to the others. And a high NPS helps with StoneCo's business growth through word of mouth marketing among the small merchants community. And on monetization, StoneCo basically subsidizes the POS devices to get the merchants in first to become their customers. And once the customers start using StoneCo's POS and payments processing and slowly gain trust in StoneCo's quality, then StoneCo starts upselling and cross-selling all the different various services to fulfill the merchant's needs. And once the merchants use many different services from StoneCo, which are all integrated together, then they are almost locked in and unlikely to switch out. This translates to recurring revenues for StoneCo and also high lifetime values or profits for StoneCo. On the market size is huge at about 120 billion Brazilian reals for the different markets that StoneCo operates in, like acquiring, banking, credit, and software. And StoneCo currently only has low single-digit market share, and the market itself is also growing fast. So there are a lot of runway and tailwind for StoneCo's business. Now let's look at the financials. I know a lot of people like to look at numbers when it comes to investing in companies. So in the past 5 years, the revenues and profits, as you can see here, have been growing very fast at a compounded annual growth rate or CAGR of 66% for revenue and 144% a year for gross profit. This basically means that the revenue has increased from 2016 to 2020 for about 8 times in just 4 years. So 400 something to 3 billion, reaching 3.3 billion Brazilian real in 2020. And gross profit has also increased about 36 times here in just 4 years' time. And for net profits, they have basically turned from negative in 2016 and 2017 into highly profitable figures that you see now. And this is quite different from the many technologies companies these days that you see, which are either loss-making or have negative free cash flows. So StoneCo has a much higher profitability while still reinvesting a lot in your business. So a question now, at this point, just by what you have learned about this business now, what do you think about this business? Do you like this kind of growth? If you like this kind of growth, you think it's fast enough for you, you can type yes in the chat. Or if you think it's too slow, not for you, you rather go for a few 100% growth, type no in the chat. Let's see what everyone thinks. I see many yes. Anyone no? No? Cool, sounds like people are liking it so far. So let's continue. Now on profitability, as I've just said, the profitability has been increasing fast too, both for the gross profit and net profit margins. Because if you think about it, StoneCo actually has a lot of operating leverage. Let's think about this. When StoneCo want to expand into a new city or a new neighborhood in Brazil, they need to set up new hubs. And then they go and hire and train many new employees, regardless of the demand that they're getting yet. And then they also subsidize a lot on their POS device and also sometimes their software just to get in those new customers. And then it's only over time that they will increasingly get more customers and the existing customers will start adopting different services, contributing to more revenues. So this actually means a lot of upfront investment done by StoneCo early on, and they'll only get to enjoy the rewards later. In 2020, some of you will realize that the profitability figures has come down a bit. And that's because StoneCo saw so much reinvestment opportunities that there's a lot of demand in the market that they reinvested a lot into their sales and marketing expenses and also expanded a lot in that year. If we look at the quarterly data, it's the same trend too, everything going up for the number of clients, for the payment volumes, or the revenues. And you'll realize in 2021 Q1, the revenue was actually hit here. And that's due to the second wave of COVID-19 lockdown in Brazil. And also in Q2 this year, revenue was further hit by some issues with its credit business, which we'll discuss shortly. Now let's look at the number of users as shown in this chart, where This chart shows the number of clients using StoneCo's payments services, their software solutions, their banking solutions, and also their credit solutions. Before 2020, we can see that StoneCo has been paving the foundation of its business, launching new solutions and trying to integrate all those technology platforms together so that it's seamless and integrated. And when all this foundation is all set, then we can see that in 2020 itself, going forward, the clients started using a lot more of all those different services and solutions. And this is a time where StoneCo starts to reaping their their rewards of the years of earlier investments that they have made, and try to lock in all these customers into different solutions for future revenues and profit. So at this point of time, what do people think of StoneCo? Based on your understanding now, is this the type of good business that you might want to consider owning for the long term, together with Berkshire Hathaway as your investing partner? Or there are certain things you don't like about it that it might not be something that you want to own? Again, feel free to let me know in the chat just to get a sense. Potentially something that you might want to consider or not. I've got Han's interest, and your takeaway is focusing on operating metrics, liking it so far, and churn rate is good. Sorry, churn rate is low, so it's good. Brilliant business. So let's move on. I've seen not so far, and yeah, like Rupam said, this is not a recommendation. And now let me show you the ugly things. When all of you are liking it, I will tell you the ugly things. So in 2021, things actually don't look that nice on the surface, which led to StoneCo's share price crashing down in the recent months, as some of you have spotted, like Aqua Giant has spotted. So in 2021 Q2, despite having grown so fast in the past, StoneCo's revenue, their total revenue, actually dropped by 8% compared to the last year. And this is mainly due to an 88% decline in their financial income revenue. So it's a big drop, 88% decline. And the main culprit is actually its credit lending business, where recently the Brazilian government was trying to centralize all the credit registry across all the different providers. But as with a government in some of the developing countries, sometimes they screw up. And the Brazilian government screw up on the technical implementation of the system. And this allows the borrowers to overborrow, and therefore they might be defaults down the road, affecting the lenders if the borrowers can't pay the loans fully. And this is actually an industry-wide issue. So it's not just affecting StoneCo, but everyone in these industries, because it's not the company's problem, it's the government's cock up. And StoneCo's management has said that the issue is temporary. The government is trying to fix it, and they think that they can fix it by the end of this year. So let's see. And we at MoneyWiseSmart see this as a short-term problem that probably matters a lot for the short-term traders. But if you are a long-term investor, this issue should not affect us much. And if we exclude this credit business and look at the other businesses, you can see here that the core business has actually been growing very well, including in the quarters in 2021, in terms of both the revenue, which has grown 68% over the previous year, and then in terms of adjusted operating profit, it has also grown by 58%. And I mean, that's pretty good enough to me. And in terms of users and average payment volume per user, they have been growing fast too, including in the latest Q2, and also further in July 2021 for both the small and medium businesses, and then also the micro merchants, which are even the smaller ones like individual entrepreneurs, and which is under their Ton brand. So this is all good for StoneCo's long-term prospect, because if you think about it, more users now mean more users in the future, and more users for its overall business, and also its credit business once the credit business issues get resolved, which translates to more future revenues and profits. And StoneCo itself has been buying back a lot of its shares recently after the share price came down. In Q2, it spent almost 1 billion Brazilian reais to repurchase its shares, which was more than its total revenue of about 600 million Brazilian reais. So overall, what do people think? Do people think that StoneCo is facing a short-term problem now? And its shares could be undervalued now, given that the company itself is buying back so much of its shares? Or not really, it's a long-term problem? Let's see, again, what people think. You can let me know in the chats. And now let's look at what we ourselves at MoneyWiseSmart did with StoneCo when we researched it back in 2020, and how did we evaluate. And Rupam, just a minor point, I think my chat for some reason has frozen, so if there are any urgent messages, you can unmute and let me know while I move on to the next slide.
Sure.
Thanks. So what did we do? First, we spent a few months studying StoneCo's business in detail last year on the different aspects of the business shown in this slide to see whether it's a good business without thinking about its valuation first. Because if a business is good, it is likely that it will continue to grow for many years, and throughout that period, there definitely will be chances to acquire the shares at a good price. So we focus on identifying really good businesses first that we want to own. And when we finished researching StoneCo in around September 2020, the share price was around $50. And then we work on its valuations to see whether that's a good price. And in general, when we value a business, we use different valuation methods depending on the company and situations. And for StoneCo, as there were a lot of growth expectations embedded in the share price, we wanted to see how much growth would justify the share price then. So we actually did a reverse valuation of StoneCo. And now we are going to talk about this valuation method in detail. And in our investing fundamentals course, we actually cover this method in detail together with other valuation methods, including the valuation methods for the SaaS or software as a service companies. And now I'll just give you a short summary of what we covered in that course for this reverse valuation. So when we did the valuation for StoneCo in September 2020, StoneCo's market cap was about 82 billion Brazilian reals. And we want an investment return from it of at least 15% a year. So if we look at the, say, 5-year horizon, the 82 billion market cap will have to grow by 15% a year for 5 years to become about 165 billion Brazilian reals by 2025. And then in 2025, we think that a reasonable PE multiple to pay for StoneCo is at least about 25 times, given the strength of the business, its mode, and also its growth, which means that its profit in 2025 has to hit about 6.6 billion Brazilian real. And the question for us investors is, if this is what needs to happen for us to get 15% a year, is this kind of profit level in 2025 reasonable, or is it achievable? So now let's look at what roughly needs to happen for that 2025 profit level to be achieved, for us to earn an investment return of about 15% a year. And here's one set of growth assumptions where the target profit will be achieved. For those looking at this slide for the first time, it might look complicated, but it's actually quite simple, and it's a systematic, logical way for us to get a sense of how the company will look like if they grow by certain growth rates. However, please note that we are not making any predictions here. We are just doing a reverse valuation to see at a specific share price what kind of growth is the market expecting, and then we can decide if it makes sense to pay for it. And let me run you through the calculations now. For the profit to hit 6.6 billion, so everything from now on is in Brazilian reals in 2025, that will mean a compounded annual growth rate of 42% from the 800 million actual level in 2019, which was the most recent year we had when we did our valuation back in 2020. And what does 42% compounded growth rate mean? Let's break things down into revenue growth and profitability. And on revenue, if we assume that the revenue in 2020 would only grow by 21% due to the negative impact from COVID lockdown, and then in the next 5 years, it grows at 50% a year, slowing down to 25% a year in 2025, then we'll get this kind of revenue levels. Next, we assume that the total cost would grow as fast as revenue in 2020. So no operating leverage there in 2020 due to COVID impact and heavy reinvestments. After that, we assume that the total cost will grow at about 60% of the revenue growth rate due to gross margin and operating margin leverage. And then for taxes, we will slowly increase to the 34% statutory tax rate in 2025. And this would mean that StoneCo's net profit margin would increase to 44% in 2025, higher than the about 30% now. And then StoneCo would hit a kind of 6 billion net profit level that would allow us to earn 15% a year if we had bought StoneCo at $50 per share. And after you get this scenario, you can then decide whether these assumptions make sense or are achievable based on its past results and your understanding of the business model, the market growth, and future prospects. And then you can decide whether this is something that you want to pay for based on the risk-reward dynamics. Now, some of you might say that, oh, those growth rates are still too high. I don't want to pay for them. So let's look at a more conservative scenario and see how much we as investors will be earning in that scenario. So if we keep the previous assumptions, but we reduce the revenue growth rates to 35% in 2021, slowing down to 25%, instead of the previous assumption of 50% going down to 25%. And then for cost, we also assume that the total cost would grow faster in this scenario at a rate of 75% of revenue growth rates instead of the previous 60%. Then the equity value of StoneCo would be about 104 billion by 2025. And if we do the discounting, this implies a 5% annual return from the level in late 2020. So basically, you can see the situation as heads you win, where you get 15% return a year if the first set of growth assumptions turn out to be true. Or if the coin becomes tail, you still do fine, where you earn 5% return a year if the actual growth is closer to the second scenario, which is more conservative. So we have to understand that in investing, it is always about a range of outcome instead of a specific certain outcome, particularly for the high growth technology companies where the future growth rates can be very uncertain. And if you know how to do a reverse valuation and understand the risk rewards for different scenarios at a specific share price, then you can make informed decisions on whether you want to invest in those kinds of risk reward dynamics, or whether you want more margin of safety and wait for the share price to come down while parking your cash in the bank, maybe earning 1% a year. So what we have just learned is how to do a reverse valuation to figure out the growth rate embedded in a share price. And you can basically do this for any high growth companies that you are interested in at any point of time. For example, you might only get to know about StoneCo in, say, early 2021, when the share price has already shot up to $90. At that time, you can do a reverse valuation yourself to see what kind of growth is embedded, and then decide if you want to invest at that price. And if you think the price is too high, there are actually methods that we can use to position ourselves to own the business at a good price, which Rupam will talk about later. And before I pass on to Rupam, can you all just let me know whether this reverse valuation makes sense or whether you have learned something from today? You can let me know in the chat. And I hope you have learned something interesting from my session today that you can take away with. I can't see the chat, so I can't respond to it, unfortunately. And now, moving on, you will have heard us saying in our emails that long-term investing is not just about identifying all these exciting multi-bagger companies and then buying into them and holding them. There are actually other issues that are not so sexy, but important to consider too, which can affect our long-term investing results materially. So now, Rupam is going to talk about them, and I'll hand it over to Rupam.
Thanks, Fanlian. That was definitely very informative. Actually, yeah, there were some questions which I addressed, and people feel that it was quite helpful. So I will take the baton from Fanlian, and right now the information which Fanlian provided to us was that towards the end of 2020, when we were researching StoneCo, the share price of StoneCo actually ran up quite a bit. I think it even went to the 90s, and we are conservative investors, so we did not want to buy at that level. So I will cover strategies that we used to get around that. Okay, so let me share my screen.
And Rupam, I'll just restart my Zoom in the meantime. Yeah.
Sure. Okay, guys, can you see my screen? Okay, can Fanliang has just gone out. So can someone just unmute yourself and confirm that you can see my screen?
Yep. Yep.
All right.
Yes.
Awesome. 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 Okay, guys. So this is the section where we discuss several concepts in investing, which unfortunately we do not pay too much attention to, but I'm going to show you how important these aspects are. Now, I have taken the example of three particular areas which are extremely important and play a very large role in our long-term results. Insurance, tax, leakages. Now, there are many others. In fact, right now, we are holding the capstone tutorial for our option series subscribers, and every month end over September, October, and November, we are going to introduce some of these non-core issues which affect our performance. But here we are going to discuss just these three. Now I'm going to start with insurance. And some of you would have noticed this, that a couple of days back, I posted this scenario. I posted a poll. Basically, this is a real quote. My 19-year-old son, I asked my insurance agent to send me a quote for two different types of insurance. One is a term insurance and one is a whole life plan. Many of you would be familiar. A term insurance is basically a plain vanilla insurance, which, the coverage term is till 70 years and it only pays out on death. And there are some other riders like permanent disability, terminal illness, etc. A whole life plan, on the other hand, you can consider it as a term insurance plus there is an investment component. Now, because of that investment component being added to the term insurance, you see the annual premium is significantly higher. For the term insurance, it's $950 per year, whereas in case of the whole life plan, the premium is $4,350. But the difference is the premium is only payable for 10 years. And after that, there is no premium to be paid and the coverage continues for whole life as long as he lives. Whereas in case of the term insurance, the coverage is only till the age 70. And the total premium, the sum total premium paid in case of so A is basically the whole life and B is the term insurance. So for E's, I'll just call it A and B. The total premium comes to about $43.5 thousand in case of A, whereas in case of B, the total premium comes to $48.5 thousand. And if I choose to surrender the policy, I is my son Namit, surrender the policy at the age of 70, the whole life plan, A has a cash value. And the estimated cash value is $133,600. Whereas in case of B, there is no surrender value. So after 70, this is like a put option. The option expires. The option has a 70-year life. So I had posted this poll on two different groups. One is, the Seedly personal finance group, which is supposedly the largest personal finance group in Asia. And the other is our investment forum group. Now, very surprisingly, on Seedly, 76% of the respondents opted for A, which is the whole life policy. Whereas on the investment forum group, almost 75% opted for B. So this is not even a neck to neck. It's completely opposite result. And why did that happen? Now, before we get into the specific case study, and I will show you what is the right way of evaluating them, and it all rests on the bedrock of something called time value of money. The time value of money is the most fundamental concept of money, and anything to do with money rests on that. You keep $100 in a bank, and if the bank is paying you 2% interest, so after a year, the value of the account goes to $102. Or while valuing a stock or valuing a bond, insurance, everything rests on the principles of time value of money. So our subscribers are already quite familiar because we have modules on time value of money, but I'll quickly give you a run through. Now, the first principle is a certain amount of cash flow received today is not equal to the same cash flow received a year from now. And that is not equal to the same cash flow received 2 years from now. Now, if we receive $1,000 today, the value of that $1,000 1 year from now is 1,000 multiplied by 1 plus R, where R is just the interest rate or the cost of capital, or basically the opportunity cost. I mean, we call this the opportunity cost. It's also the rate of return that you can achieve on the $1,000. So 2 years from now, the future value is 1,000 multiplied by 1 plus R, again multiplied by 1 plus R. So that is how future value is calculated. Now, there are a lot of calculators available online which you can use. But as you know, in MoneyWiseSmart, we believe in approaching everything from first principles. And it's important that you actually understand the underlying formula of how future value is calculated, how present value is calculated, and that will really give the reins on your hand in terms of understanding a lot of these concepts much more easily. So just like we saw how future value is calculated, present value is just the reverse of that. So $1,200 of cash flow 1 year from now is equivalent to 1,200 divided by 1 plus R, where R is the opportunity cost. And $1,200 2 years from now, the present value is the value of it today is 1,200 divided by 1 plus R squared. So if I want to calculate the total present value of these three cash flows, I can't just add the three. I have to take the present value of all the future cash flows, and then I can add. So the present value will be this plus this plus this. And if you can draw the correlation, even the way we value stocks, I mean, it's basically we are calculating the present value of that. So the present value, the value of any business is nothing but the present value of all future cash flows that we receive from the business. And whether we are buying it, whether we are paying an expensive price or a cheap price, it depends upon the price that we are paying. How does it compare with the present value of all future cash flows? So the concept is as simple as that. And as I said, it rests on the bedrock of time value of money. So here is an actual example. If R is 5% and the T time period is 10 years, then the present value of $1,000 received 10 years from now is 1,000 divided by 1.05, that is 1 plus 5% to the power 10, which is 614. So similarly, if your opportunity cost is 10%, and if the time period is 10 years, then the present value of $1,000 is only $386. So as you can see, the longer the time is, the present value becomes lower and lower. And the higher the opportunity cost is, the present value becomes lower. So if I tell you that I'm going to give you $300,000 50 years from now, you should not be too excited, because the present value of that $300,000 is actually a very small figure, because time sits on the exponent. So similarly, 10% opportunity cost, 20 years time, the present value of $1,000 becomes just $149, which is like 1/6 of the actual notional amount. Now, again, to repeat, money cannot be added across time. Now, if I got paid $1 every time I see someone adding money across time, I would become a very, very wealthy person, because this is a very common mistake that is very often done. And you would remember that when I showed you what my my insurance agent sent, I had highlighted the figure where he showed the cumulative premium paid in case of A and the cumulative premium paid in case of B. So clearly, my insurance agent does not understand the concept, or maybe he did not pay attention. In fact, I think he does understand, but somehow he just passed on to me what he got from the insurance company. And this is how often, the insurance companies, they actually mislead their customers, because you just cannot add premiums across time. But that is exactly what they did. And just by adding that, it felt like the premium being paid for the policy A is much lower than policy B. Now, our subscribers have heard me say this so often that I know I sound like a broken record in emphasizing the importance of time value of money. I have actually conducted several sessions on it, both offline. In fact, some of you who attended this session are also present here, and as well as online. We have modules on time value of money on every course of ours. Now, let's go to the actual case study, and I'll stop sharing the screen and take you to the worksheet, where we will dissect how to compare these two policies. And just bear with me, guys. Today, a couple of times I will toggle between the presentation and the worksheet, because the case studies are all there. Okay, you can see the sheet, right? So on the screen, I have outlined the whole life policy. So this is basically the sum assured of both the policies, 300,000. And here, this is just an input field where you can call it the rate of return that I can expect to, generate on my investments, or the cost of capital, or the opportunity cost, or discount rate. Use any name, but they all boil down to the same thing, that it is my opportunity cost. If I'm not giving money to someone, by investing that money, I can earn this return. So I will show you what the comparison looks like if I change this to 8%, or if I change this to 15%. I mean, my opportunity cost is actually much higher, because the return that I generate on my investments is much higher. And actually my son's opportunity cost is probably even higher, because his investment portfolio has done even better than mine. So here we have the details of the whole life policy, 4,352 premium. To show the outflow, I have shown a negative. So that only goes out for 10 years, whereas the term insurance, the premium goes out for 51 years, up to the age of 70. And here, as I said, they have, unfairly, they have just added the premium, but we just discussed that we cannot add money across time. So this is a meaningless thing to do. Now, the cash surrender value for the whole life policy at the age of 70, I think what most insurance companies do is they invest in bonds. So the returns that they factor in are actually not very high. The surrender value is 133,000. And the term insurance has no surrender value. Now, the right way to look at the premium, if I have to compare the premiums that we will have to pay for both the policies, is if I take the present value. And at a discount rate of 4%, you can see even though the term insurance premium is being paid for 51 years as compared to only 10 years of premium payment for the whole life policy, the premium, the present value of the premium is a lot higher than the present value of the term insurance. And guys, in case any of you are wondering, hang on, this is an investment webinar. Why are we discussing insurance? Please bear with me. I promise you that you will be able to draw the linkages, and it's a very, very important linkage. So clearly, what the insurance company tried to sell in terms of just accumulating the premium, that is an incorrect way of doing it. So now let's open up another sheet. So the right way to compare between the two premium flows is to ask a simple question, that for the first 10 years, instead of paying $4,352 premium, which is about $3,400 more than what the term insurance premium is, what if I invest this $3,400 on my own, just for these 10 years? Then what are the results? So let's see what the results are. Now, at a return of 4%, why am I taking 4%? Because for those of you who are from Singapore, even CPF special account gives a 4%. Actually, it's more, because over the first, I think, certain amount, the return they give is more. So even at 4% interest, the future value of investing the difference is much higher than the cash value, the cash surrender value of the whole life policy. So there itself, you can imagine that the whole life policy falls flat. But then I'm not going to earn 4% on my, even if my son decides that he's just going to invest in index funds, and if I take a historical kind of return of an index fund at 9%, look at the difference. The difference that can be invested, even if he regularly puts it in an index fund kind of a investment, it far eclipses even the sum assured of the insurance. So guys, you realize that isn't this itself becoming an insurance if he, in a disciplined way, invests, doesn't blow up his money and just invests himself, in a disciplined way. Now, what if the return is 15%? And by the way, I mean, my returns have been more than 15%. Just look at the difference. So $133,000 versus $24.5 million. And that is what, that is the right way to make this comparison, that rather than paying a higher premium here every year, what if I'm a intelligent investor, or what if I'm an average investor? I don't think it requires any intelligence to religiously invest money in something as simple as an index fund. Even if I do not have the ability to, even if I'm not as smart as Fan Liang or as smart as many of you are, and I do not have the ability to go and pick stocks, even then, the difference is just staggering. And this is a reality which I think most people on the investment forum group, they realize, because there is an investors group, whereas the people on Seedly, and I don't blame them, because this is not intuitive at all. We do not think in terms of time value of money. When we are thinking, 50 years of premium, we are not thinking in terms of time value of money, that the present value of that premium is actually nothing compared to the present value of the whole life premium. In fact, higher this discount rate is, you remember the formula which I showed for the present value, the lower is the present value, because this discount rate goes in the denominator, and longer the period is, the discount rate is even lower. So this is the reality which we have to keep in mind while evaluating. Now, this is the example of insurance. You can use this concept to evaluate any set of cash flows. It can be an insurance. It can be, let's say you are going and taking a gym membership and they say that, okay, monthly membership is $100, but if you pay a lump sum for a year, then it is $1,100. So, so you can't just immediately jump into that, oh, $1,100 is less than $1,200. No, because there you will be adding money across time. So you have to, of course, this is a very simplistic example, but you have to use your opportunity cost and you have to think that, what is the present value? How do they compare? So I will stop the sharing. Do you think this was useful? This concept. If you think this was useful, then type yes. Okay. All right. Fantastic. So I know that you guys are still awake, and that's the reason why. Okay. So I go back to our presentation and go to the next section. Please bear with me. Share screen, presentation. Now, this is the reason why we want to be like an insurance business as opposed to a customer of an insurance company. Of course, we all need insurance, we have medical insurance. For those of you who drive, you have to take car insurance. You might, take insurance for your household goods or even, life insurance. But when you think like an insurance business, and here you realize that the whole life policy is something which is actually very easy for insurance businesses to sell because they make it sound very attractive. And imagine all that money, while the sum assured or the cash surrender value that they are offering is probably a small percentage of what they themselves are making. And that is the reason it is a well-run insurance business is an extremely attractive insurance business. So for those of you who are not familiar with how an insurance business works, I'll just give you a quick primer. Again, our subscribers are already familiar with this. Now, there are two main functions in an insurance business. You can say two main departments. One is the underwriting function, which basically writes the policies. And we have some actuaries here. So, they know very well, it's their job. Like I know Connor and YP, they're all actuaries. So it's their job to evaluate and underwrite an insurance policy. So when an insurance company sells a policy, it brings in the premium, which is a cash inflow that they bring in. And then they have their own expenses for running the company, and they pay out the claims. However, there is a long time lag between the payout of the claim and the premium inflow. And this time lag could be several years or sometimes even several decades, depending upon what type of insurance it is. For example, in case of the term insurance that we saw, it can be several decades, or the claim might never happen. So what the insurance company does in the meantime is that cash, which is available to them after all their immediate expenses, they use that to invest. And they basically pass it on to their investing arm, and the investing arm uses that cash to invest. So they basically take advantage of this large time lag between the claims and the premium inflow, and this is called the float. And they invest the float and they make money. Now, for those of you who are familiar with Berkshire Hathaway, Berkshire Hathaway, they have several insurance companies, and this is a snapshot from one of Buffett's letters to his shareholder. This is the letter which came out in 2020. So let me just read this part. This collect now, pay later model leaves P&C, that is property and casualty, companies holding large sums, money we call float, that will eventually go to others. Meanwhile, insurers get to invest this float for their own benefit. Though individual policies and claims come and go, the amount of float an insurer holds usually remains fairly stable in relation to the premium volume. Consequently, as our business grows, so does the float. And how it has grown, as the following table shows. So in 1970, Berkshire had a total float of $39 million. Now that has grown by 3,300 times to almost $129 billion, $129.5 billion. So you can imagine, and this is a secret of Buffett's success, which a lot of people don't realize. And this is something which we have talked about in the past also, that Buffett's portfolio is available for public to view. It is not as if he identified investment opportunities which no one could. Guys, those opportunities were available to a lot of people. Coca-Cola is a public company, Coca-Cola, American Express, etc. But it's his genius is using this free money to invest as a source of funding. And unlike most other insurance companies, Berkshire's insurance companies, they invest in equity, in common equity. And that is what has compounded his wealth over time. And this is why we like to be an insurance company too. Now, we do not have a license to run an insurance company. I don't have a license from MAS, but the good news is that everybody, each of you can have your own insurance company and you can replicate exactly the same business model using options. Now, in case of an option, also, we bring in premium as cash and, we have our expenses, even though our expenses are very, very low. But the difference is, in case of an insurance company, when a claim event happens, where you remember here, it was the claim event, the money goes out of the system. But in our case, this premium comes in and we not only get to invest this premium, the money never goes out of the system. Our claim event is equivalent to, let's say when we sell an insurance, the equivalent is we sell a put option. Our claim event is that we get assigned on the put option and we just own the stock and the stock stays in the system. So this is a brilliant way to use options. And this is not option trading. Most people that use options, all the other option course that you find in the market, they are all talking of option trading. They're speculating on the direction of the stock price, and they're trying to, make a quick buck. Whereas we use options the way Warren Buffett uses options. He elegantly explained in his 2008 shareholder letter, which is basically the exact same structure of an insurance business, using float while we are waiting. Now, I'm going to share an actual options strategy on the same company that Fan Liang presented, that is StoneCo. Now, when we were researching StoneCo, it was towards the second half of 2020. And, as you would have, what Fan Liang presented today is probably, I would guess it's 0.5% of the total quantum of research that we have carried out. And our research happens over several months and sometimes even years, because we think like long-term business owners. So we would like to know everything that is out there to learn about a business. So while we were researching the business, the share price just kept going up and up and up and up. So we were not too happy because, we wanted to buy the company, and our range of intrinsic value per share, it is always a range. Intrinsic value is never a precise amount. It was somewhere between 45 to 55, roughly. So we would be okay buying at 55. We would be happy to buy at 45. But by the time we realized that this is the intrinsic value, look where the share price was. The share price had, crossed $90. So we decided to patiently wait, because we never ever believe in chasing the share price. We know that, we will get, as a long-term business owner, we know we will get opportunities in future. So even if we don't buy today at 50, maybe a few years down the line, we can buy it at 60 or 70 or maybe even 100. But you again apply the concept of time value of money. If the intrinsic value of the business is growing at a rate of, let's say 15% or 20%, so the value of today's $50 would be maybe, $100 a few years from now, applying the same concept of time value of money. So we have no problem in waiting. And instead, what we did was we decided to sell a put option at 55 strike, which generated a nice cash flow for us. Now, by doing that, we took on the obligation of buying StoneCo at $55 a share. Now, this is a screenshot from the software that we use to track all our options programs. So just follow the cursor here. So we on 16th March, we sold a long-term put option. We sold 9 contracts of this option at $55 strike. And this option has 675 days to expiry. And in the process, I brought in $12.50 per contract. So brought in a total cash inflow of $11,250, which is available to us as an insurance business. We would like to invest this because it's available to us for 675 days. Now, in the process, I took an obligation of buying StoneCo at $55. So one very important thing to highlight here, that we never believe in buying on margin. So if we have taken that obligation, we would like to keep the cash aside. So the total capital reserved for a possible assignment of my option is 9 contracts multiplied by 100, because every option contract controls 100 shares. So 900 multiplied by 55, which is 49,500. So this money, rather than just leaving it in the bank and on close to 0 interest rate, we kept it aside and we sold this put option. So the cash inflow from the option premium was again 9 multiplied by 100 multiplied by 12.5, which is 11,250. Now, there are 2 ways of thinking about this option premium. One way of thinking is that I can just sit on this option premium without doing anything. And I can think that at least I have, by selling this put, I have brought down my break even to 42.5. Or the other ways, I say that my capital is 49,500 and this 11,250 is my return on that capital, the return that I achieved for 675 days. So on an annualized basis, if I calculate the IRR, it works out to 15% IRR. So now you remember Fan Liang mentioning that when we look at a business, our minimum targeted return, that is long-term return after we own the business, is at least a 15%. But look at the beauty of this. This return I managed to implement on the capital that I'm sitting on even before owning the business. So that is the beauty of this particular strategy of thinking like an insurance business. Now, this return will happen. This return of 15% will happen if by Jan 2023, if the StoneCo share price stays above 55. So then we will not get the shares, but we have at least secured this return for close to 2 years, 675 days. However, if StoneCo share price falls below $55 by the expiry of the option, then similar to the insurance terminology, a claim event happens and we are obligated to buy the stock at $55 a share. So in option terminology, it's called an assignment. But is that not what we anyway wished for in the first place? So it's actually a great outcome for us. Unlike an insurance company, when an insurance company receives a huge claim, they have to pay out the claim. Whereas for us, on the assignment, we ended up owning the stock at $55, which we wanted to do in the first place. And moreover, we get to invest the 11,250 cash inflow, which we received by selling the put for 675 days. So isn't it amazing? And this is the reason why when Buffett first got to know about how an insurance business works from Lorimer Davidson, the then CFO of Geico, he had a major aha moment. And when I learned from Buffett how an insurance business works and how we can use options exactly similar to an insurance business, it was my aha moment. Now, following this exact strategy, this is how our monthly cash flows look like. Now, I have been using this strategy for a long time, but since April 2017, I have recorded every single option transaction of ours. And this shows and this is all in US dollars. This shows the cash flows. We would have started with around close to $4,000 to $5,000 a month, and see how it has beautifully grown. And if you take the average of this, it works out to $16,000 to $17,000 every month. I mean, there are some months where I have even brought in a cash flow of $135,000. This is about $65,000 to $70,000. So this is how we use options to bring in this cash flow, which is a float. The red bars are not losses. By the way, this is not P&L. This is just the cash flow that we bring in. The red months are simply because in these months, we probably purchased more options because of some opportunities than what we sold. But on an average, this is how it looks like, beautifully growing. And on a cumulative basis, since April 2017, in the last about 4 years, we have brought in a total amount of cash flow of about $700,000. Now that is our float, which was available, which was not our money, but it was available to us for investing. And by investing that float, the future value of that float would have grown significantly more. Now, of course, we are trying to do the same strategy, but a few zeros are missing in our case when I compare it with Berkshire's float. But hey, we are following the footsteps of the master, So if I religiously, follow the same strategy, I know that a few decades from now, this can be a very significant amount. I mean, it's plain and simple compounding. It's a math. Now, this is what actually happened in case of StoneCo. So I showed you that, when we finished our research at that time, StoneCo was at $90, and we also know the reason why the share price has come down. Now, this is a fantastic outcome for us. Now, our put option is still there. So we still have the obligation of buying StoneCo if the share price remains below 55. But, we are happy to, because we have kept the cash. But thanks to the float, the copious amount of float that we bring in, we are now able to take advantage of the market price, which is way below our range of intrinsic value. And we have been buying StoneCo. So you see, IB even shows, has marked it. This is my average purchase price, and which is, I think, around $38, which is way below the intrinsic value. And again, if you understand the principle of compounding and time value of money, if purchasing the stock at $50, I can expect a long-term return of about 15-20%. Then purchasing it at $38, my long-term return will be even higher. So that is the reason why when stock prices of one of our businesses come down for whatever temporary reason, this is when we celebrate. This is when we pop the champagne. Now, this picture is in the spirit of transparency, and our subscribers know that I always feel that I have invited you to this webinar, and many of you don't know me. So why should you listen to me unless I actually have something to maybe share my experience. Now, this is the actual PNL, the current PNL of my option portfolio using that same float. So I showed you that we brought in $700,000 of cash flow, and you can see that my PNL is currently my option portfolio PNL using that same float is sitting at almost $2.6 million. And a large part of that is thanks to that float, the money which, which I'm using to invest. Now, the thing is, this is just to demonstrate. I'm not trying to brag by showing this. I'm just showing you what a systematic strategy, following it in a disciplined way, what it can do when you use the simple principles of compounding. And that is exactly what has happened. And you can see there are several reds, several positions are in the red, which is absolutely fine. It doesn't matter. What matters is what's going to happen in the long term. And some of you who have seen me present know that this number is extremely volatile. So this is also not something which is anything to brag about. There was a point of time it used to be above $3 million. It has even gone down to negative during the COVID period. It's extremely volatile, but it doesn't matter. At the end of the day, we think like long-term business owners. And you will see that there are some long positions here, like OZK. Here you can see Stone stock long position. So some of these where either my puts got exercised or I managed to use the float to go and buy it from the market. All right, so let's progress. Now, using the same float, I'm going to share with you some great opportunities which we were able to capitalize just because we had access to that cash flow. Now, those of you from Singapore are very familiar with this company. This has been the best performing Singapore stock. And we have, in fact, I was, through some filter criteria, I identified this particular stock in somewhere mid of 2018 and have been researching this ever since. My first entry point was at $1.12. But last COVID time, even though this looks like a small groove, a small blame, but actually this was a over 50% drop. In relative terms, you can't make out now. And the share price had dropped to below 70 cents. And thanks to the availability of float, I managed to heavily purchase here. And this has now become a 9-bagger for me. And you can see, many of you know, most of these people here are friends from gym. So we actually have this iFast discussion group, which has been going on for many years now. You can even see the date of this discussion, 13 Jan 2019. So we have been following this company in detail, researching this company, with these guys since 2018. We have gone, we attend the AGMs, meet the CEO. So this is how deeply we look at a business when we like the business. Some other examples. This is a company in India which I've been owning for a long time. This again has been a 7-bagger. And by the way, what gives me even more happiness is that some of you, who are present in this webinar have benefited from these exact same ideas. And that is what, when our subscribers thank us for some of these ideas, and that is what gives us immense amount of pleasure. So again, the same thing, our initial purchase happened below 1,000 rupees, but when the share price dropped, availability of float allowed us to buy more. So 7-baggers here, a fairly significant position. JD.com, we have been buying since it was around $30, and many of the guys that you saw in the picture, we also researched JD.com together, kept buying till it was at $19, and as of yesterday, it's above $85 now. So again, a very good result. But then, you know what? I'm not showing this to, to kind of brag about the share price run up, because we think of ourselves as long-term business owners. I will be, unless something is fundamentally wrong, with the business, I will be owning these businesses for maybe decades, unless there's a significantly better opportunity that comes up. So it actually helps me when the stock price goes down, like here or here, allows me to, buy more as compared to the stock price running up. Now, always it does not, run up in the short term. China Maple Leaf is one company which we researched extensively. Unfortunately, the share price has not done well because of all the China risks and all. But China Maple Leaf, I recently had some concerns, and I had published that in a video that has got nothing to do with the share price going down. In fact, the share price going down can be a good thing, but there are some other reasons. I think their international expansion strategy, they are not generating enough cash internally to support that, which means their balance sheet is going to get weaker and weaker. So I have published a video about that. But then we never acting in a haste. I mean, Upwork had followed exactly the same trajectory when we researched the company. After I bought Upwork, the share price had fallen to half. But just because we are patient and just because we understand the business inside out, and we have the availability of the float to take advantage of the share price drop, see what happened. So this new position has already become an 8-bagger for me. Now, what kind of a track record, overall track record, does all this translate into over time? Now, I showed you, the option portfolio, but that's just a snapshot of the current, time period. So our investment track record, again, in the spirit of transparency, let me know if you guys are interested in me sharing our investment track record. So type yes if you are interested. And if I see enough interest, then I will share with you. Okay, excellent. So there's enough interest. And I think it's only right for me to share our track record. Otherwise, why would you want to listen to me? So this is what my track record of my early years of investing looked like. And I'm not trying to be cute here. I'm not trying to be funny here. This is the actual chart from my very early days of investing. And as you can see, it doesn't look pretty at all. This is, during the financial crisis. And this was a result of a lot of ego. I think that was the biggest culprit. I had a very successful career, did extremely well in my job when I used to have a full-time job. And this is a very common problem with people who are otherwise successful. It's very difficult for them to accept the fact that success in one field does not guarantee a success in another field. And the investing domain is really funny. I mean, just because you're a very accomplished piano player, it does not give you the false delusion that you can also be good at chess, right? Or you can also be good at maybe brain surgery. But for some reason, all successful people, they somehow get this notion that, oh, we should be good at investing also. And they try a lot of funny stuff. It was also a result of not understanding the fundamental difference between price and value and being focused only on stock prices. It was a result of overtrading, not appreciating the concept of compounding and time value of money, superficial knowledge on companies. I did not invest I'm talking of my early years, did not invest the time and research to build conviction. And I used to pay a lot of attention to the noise. So an equivalent of the US-China trade war, I would dig up all possible articles and keep reading and keep trying to speculate. Oh, you know what? This is what is going to happen. This is what the world is going to come to an end. And all that noise, it first of all, it adds absolutely no value to our lives. It just messes up with our mind. And last but not the least, I was delusional. Now, fast forward to today, this is how the last 5 years, and I always believe that any track record, anything below 5 years is not worth looking at, because, one can be lucky, but the over time, I think the luck factor goes down, and you can see the blue bars are mine and the green are SPX. So this is the 5-year track record. And as you can see, S&P 500 has returned close to 16%, but my return has been significantly better than that, almost 21%. And this is, again, not trying to boast here, but this is on a pretty sizable, portfolio. It's an 8-figure portfolio. So it's, I think, fairly satisfactory track record, I must say. And this happened because I was committed to learn to invest the right way and followed the right framework, which involved ability to develop the ability to identify and research high quality businesses, ability to generate cash flows to take advantage of the best opportunities, very important. Even more important is develop the right temperament, gain control on my emotions, especially when the markets are very volatile. And last but not the least, developing an understanding of all the other non-sexy secrets of compounding wealth. Because I understood quite early in the day, and to a big extent, I must thank Warren Buffett for that, that if you want to be a successful long-term investor and build we are all talking of long-term is multiple decades for us. For many of you who are, early in your, maybe in your 20s, it'll probably be a 7-decade long investment horizon. So it's not only going and, scouting through the 13 Fs to see what Monish Pabrai is buying or what Lee Lu is buying. It's much more than that. And it's a deep understanding of many of these non-sexy secrets play a very important role in that. So the next non-sexy secret that we are going to talk about is tax. Now here, for the subscribers of our option series, there might be a bit of repetition here because I covered this particular case study during our tutorial, but I'm going to cover more on this. Now, let me again stop sharing and go back to our case study worksheet. All righty, you guys can see the screen?
Yep.
Okay. Now, I know some of you, who are from Singapore, who might be thinking, why do I even need to, pay attention to tax? We don't have any capital gains. Guys, please stay with me because we all pay tax. And once you understand this fundamental concept, you realize that the exact same principles are applicable to, situations like SRS investments. And you will, combining the concepts which we discussed in the insurance case study and this, you yourself will be able to evaluate whether it makes sense to, go for SRS investment or any kind of a tax deferral for other countries. I'm sure you have tax deferral options. Like I know in the US, there are, so you can immediately, understand how it works and the value that it provides. Now here, in the first case, I just started here for all my case studies, I assume my son, he's just 19 years old. In fact, right now he is doing his national service. So I assume that, someone like him starts with a portfolio of $10,000. And I've shown a 50-year track record, and all my case studies, I show 50 years simply to use an entire investing lifetime to show you what happens over a lifetime. Most of us, we often get very bogged down by the short term. We buy a stock, the stock runs up, becomes a 3-bagger, 4-bagger. We feel very happy. But the end result of an entire investing lifetime, it is much more than just, one stock running up. As our subscribers would know, that our principle is to find ways to maximize the return on our capital, to maximize the capital on which we are achieving that return. So we are talking of our entire capital that's available to us, and to maximize the time frame over which that high return on capital is achieved. So if I can maximize these 3 factors, then my long-term result will be phenomenal. And Buffett is a great example of that. So here I have taken a 20% return. Now, before you jump saying that, oh, that's too difficult to get, you can choose your number. It just doesn't matter. If you feel comfortable with 4%, take 4%, 8%, the math stays the same. So here I have assumed in the first scenario, he starts with $10,000 and he is a long-term investor, generates a 20% annualized return on his investment, but he doesn't sell. He just holds on to his investment, and he lives in a jurisdiction which has a tax rate of 15%. But because I'm sorry, guys, the first scenario is actually he's a short-term investor. So every year he's selling his investment, achieving a 20% return. And because there is a tax of 15% on his gains, so every year he's paying out a 15% tax on the gains and getting to reinvest the rest. So like this, at the end of his 5-decade period, he has a huge amount of $25.6 million. Now, in the second scenario, everything is exactly the same 20% return, 15% tax rate. But the only difference is, in the second scenario, he does not sell his investment. So he keeps sitting on unrealized gains, which means the tax is just accrued. It's not paid out. And he gets to compound the entire amount. And then at the end of 50 years, on the 51st year, he has $91 million. That is the time, let's say he decides to sell his investments, and he has to pay his accrued tax, right? So he pays a tax of $13.6 million. And you can see, even though I told you that we shouldn't add money across time, but here the amount of tax that he pays on a purely cumulative basis is higher than the tax that he pays in the first scenario. But look at his end result, $77.3 million, which is 3x of what he would have in the first scenario, simply because he transacted less and he just deferred his tax payout. So this is the wisdom of deferring your tax payout. So now for all those who are from Singapore, so think in something like SRS, isn't the same thing happening? So it's a combination of the two concepts. One is by investing that 15,300 in SRS, you are saving on some tax payout. Now, the tax eventually will need to be paid when you finally end up selling, but then that selling can happen decades from now, after you retire. And that too, there are ways of taking that money out. And only after that, you pay tax on half of that. So you significantly defer your tax payout. Plus, you apply the same concept. The amount which you save by not paying out to the government, you invest on your own. Exactly the same scenario that I showed in the term life versus whole life comparison. And you can imagine, you can do the calculation yourself and see the benefits. So you see, isn't this an eye-opener? 25 million when he's transacting every year versus 3x of that, 77 million, just by deferring his tax. So if you think this is an eye-opener, type EO, stands for eye-opener. Let me see if, good. So it's, when I understood this concept of what happens when you can defer your tax, it was a major aha moment, major eye opener for me. And again, the long-term results is a sum total of all these knowledge being put into practice. All right, so we go back to our presentation. All right. So now we come to the third not so sexy secret of wealth building, and that is leakage. Now, what do I mean by leakage? Leakage can happen in various forms. It can be in form of brokerage commissions. It can be in the form of the fees that you pay to your advisor, or or maybe your fund manager. It can be currency conversion charges. It can be bid-ask spreads. In fact, our option series subscribers who attended the last tutorial, it was a major aha moment for them when I showed them the effects of bid-ask spread. Most option traders, they don't even focus on too much on this. It can be a leakage, can be the fund transfer charges that you incur while you send money from one place to another. Maybe if you're investing in a country which is not your home country, and it can be countless others. These can all act like termites on your investment portfolio. Now, here is an example. Now, below, I have a screenshot from HSBC. I was trying to convert 100,000 US dollars into Singapore dollars. Now, this was basically at a time, brought in some cash, and this is, we often generate enough float. So sometimes we bring the float in, and our expenses, our business expenses, it happens in Singapore dollars, right? Of course, we don't need 133,000 for business expenses because we run a pretty lean organization. But I was trying to see, and on HSBC I was getting exchange rate of 1.335, which means Singapore dollars 133,543. At the exact same time, Interactive Brokers was showing me an exchange rate of 1.34295. So there was a difference of almost $700 between the two, which works out to a leakage of 56 basis points, 0.56%. Now, many of us don't even pay too much attention to these things. We just take it for granted that, oh, the bank is asking, so we have to pay this. But here, I had an alternative of, instead of doing the conversion on HSBC or DBS, OCBC, I can do it at a much better rate on Interactive Brokers. Or maybe if I have, an XC currency conversion account, there are lots of options available. So let's look at the third case study on leakage. I'm sorry, guys, I have to keep taking you from one place to another, but I don't have a better solution. So please bear with me. All right, leakage. So here I have just taken a very simple case study scenario. Again, my son starts with $10,000 over a 50-year period. Here, he gets an annualized return of 15%, being a long-term investor. And here in the first scenario, I assumed no leakage. Let's just focus on this for the time being. No leakage. So at the end of a 5-decade period, generating a 15% return, if he's reinvesting the whole amount without incurring any leakage, that he just sits like a long-term investor, long-term business owner, and like a coffee can, kind of a portfolio, ends up with $10.8 million. Now let's see what happens if he does just one transaction every year with 50 basis point leakage on either side. Now, this leakage is a combination of all the different sources of leakage that I mentioned. Just one transaction that is, if he is, going in and out, he ends up with only $6.7 million, which means he has a cumulative loss of 37% in this case. Now, let's have some fun. Instead of just one transaction, if he has 2 transactions every year, then his end result is a 62% loss. Now, just imagine when you are doing either a fund transfer or, maybe paying some brokerage commission or maybe some currency transfer, you don't think much about it because, you think, oh, this is just 0.5%. But this is the result of just a 0.5% leakage, which compounds over your lifetime. And while many of us investors, we think we understand compounding, I have noticed that the lack of the ignorance or lack of understanding of how compounding works on our expenses is staggering. Even people who really understand compounding, they don't, because this is not intuitive, because this is just 0.5%. How is it leading to a cumulative loss of 62%? And you want to see if there are 4 transactions in a year with leakage on either side, instead of $10.8 million, it comes to just $1.6 million, which means you lose 86% of your potential wealth, which is supposed to be your money. You just either you're giving it away to someone or you're just flushing it down the toilet. So this is the reason, guys. I mean, even if you are not doing fancy in terms of, what you're investing in, if you just keep in mind these things, and if you can figure out a way to reduce activity, inaction will win hands down. Your end result will be dramatically better. So that, I hope, is the message is loud and clear. So if you think, let me see if the message has gone down. Can I request all of you to type RL on the chat box? RL stands for reduce leakage. So this is like a pledge that we all are taking, in order to be better investors, that, we need to figure out ways of reducing leakage. All right, awesome. So that means the message has gone down well. Okay, so now the last section of fantastic, guys. Good to see that you're completely aligned and you're really appreciating these concepts. Now, I'm going to share with you a story of a good friend of mine. Now, this friend, he's a fitness buff, regularly runs around, jumps around, eats right, maintains good habits, sleeps in time, wakes up early, meditates, is very environmentally conscious. Somehow, I sometimes feel very jealous about him. Somehow, everything is right about him, does everything right, but just one thing when it comes to managing his investments. And I have tried telling him several times, and his retort has always been, oh, I don't have time to learn about these stuff. So I gladly, hand over my investment needs to my banker. Now, nothing about, this, nothing wrong in doing that, as long as he realizes how he is leaving money on the table. And by the way, I mean, this is actually a common friend. Many of you actually know him. And I have, even tried asking him to come and attend this webinar, but I have been unsuccessful. But I mean, to be fair to him, when I told him that, can I share your story with your picture, he very gracefully agreed. So, you'll see many of you actually know him. So this is that friend of mine. You know, he thinks he's having a great time. He thinks he is, making a lot of money, but he's not realizing how he's incurring all those. He's basically at the receiving end of all those not so sexy secrets that we talked about. Now, interestingly, my friend just sent his son to the same US university. He studied in the US, where he himself studied the same program. And he was very proud. So he basically committed to spending several hundreds of thousands of dollars for his son's higher education, which is great, which is fantastic. It's a great university, great program. And US universities are not cheap. It'll probably cost him by the time he graduates, maybe close to $500,000. Now, I keep trying to prod him, and I keep trying to tell him that it's great, but along with that, why don't you also invest in some investing education? Because I ask myself, well, you went to the exact same education program that your son is attending, but what has been the end result? You are still blissfully ignorant about all these termites which are eating into your portfolio. I mean, I told him, along with all these hundreds of thousands of dollars, maybe you should, budget to invest another, say, $10,000-$20,000 to get yourself and your son some quality investing education. Now, he, of course, did not listen to me, but, he's actually, on one hand, he doesn't listen to me, but he shares with me the products and all that he's investing in. And for those of you, who are familiar with these private banking products, or even many of the privileged bankings, there's something called ELNs, that is the equity linked notes, which is nothing but a put option, which we can do ourselves. So let's say the same example of StoneCo, that strategy. I showed you that I sold the put option where I generated a 15% return. So a bank will package that product into something called an ELN and take it to the unsuspecting client who, the client is might be rich, but does not have the necessary financial education, like my, froggy friend. And the bank goes and tells this person that, hey, you know what, this is a great product, which will give you a 6% return on your cash. So this is something like a bond investment. And my froggy friend would find it very interesting, because the bank interest rates are currently almost 0%. So for him, 6% is a very attractive return. So he would go for it. And the bank would say that, we feel that the share price will stay above $55. I have no idea how the bank came up with that, but they would say that anyway. And if, however, the share price comes below 55, then you'll have to own the share. And because my froggy friend is not investment savvy, for him, a share price dropping is a scary thing. So anyway, so he shared with me the result of all these ELN products that he invested in, over the years. And because for him, he has not researched the company, right? Neither the bank, probably even the bank people, the people who share these products, even they don't go as much as deep as we do. So every time something like this happens, he goes and sells the stock at a loss. So over the last 3-4 years, he has raked up losses just from these ELNs of over $500,000. I mean, he's a fairly wealthy guy. Now, imagine all he had to do is, go through a proper self-education program where he tried to save money, but by not, investing in his investment education. And in the process, he flushed $500,000 down the toilet. So I actually recommended that he do this. I, in fact, told him that this is a book. In fact, I'm going to gift him this book. And while we don't recommend stocks, but this is a recommendation I'm making to all of you. At the first possible opportunity, get yourself this book. You can even get a free PDF that's available, or buy it. This book has been written about 80 years back by Fred Schwed. It's a hilarious book. There have been several new versions, and this is, I think, the 2006 version, which has intro by Jason Zweig. It's an absolute must read, very relevant to many of the stuff that we are discussing today. Fan Liang, you were the other day looking for recommendations, so go for this.
Yeah, I know this book. Yeah.
Okay, all right. Now, how many of you realize that the topics that we covered today are very important, but this is just the tip of an iceberg, and there is a lot more to learn to be able to implement this knowledge? If you agree with me, then type iceberg in the chat so that I know that I haven't lost you guys. All right. Great. No, Perry, this is actually an iceberg, how the, the part underwater looks like, because what we covered, it's just the tip. There is a lot more. Now, how many of you realize that without a proper framework, it can be very challenging to achieve our desired long-term investing goals? And this framework should include the ability to identify and research high-quality businesses, the ability to generate cash flows to take advantage of the best opportunities. Very important to develop the right temperament, very important component of your framework, as well as understanding of all the other non-sexy secrets of compounding wealth. So if you agree with me, then type framework. If you think that this framework can be, a necessary framework for your long-term wealth compounding. Awesome. All right. So that's great. So looks like, we are all on the same page. Now, by the way, guys, this actually brings us to the end of the core topics which we wanted to cover in this webinar. I just wanted to say that this is exactly the reason why MoneyWiseSmart exists. So this is our why. Now, for those of you who would not be interested in knowing how MoneyWiseSmart can help you, feel absolutely free to leave now. The main content part of the webinar is over, and I hope you are taking back some valuable learnings from this evening. Thanks a lot for attending. If you think you're not in a position to take your learning forward, or if you think this is not relevant for you, however, for those of you who decide to stay and who would like to see or get a glimpse into, get some details of the MoneyWiseSmart framework, I would need your permission first to discuss the details of this framework and what we have to offer. So if you are serious in learning how you can use our structured framework to enhance your portfolio returns, and if you permit me to share the details, type serious. So if I see that there is enough serious people, then I will, share with you what our framework covers. All right, Edward, Apurv, Valerie, Lance, Pang, Kenny, great. So there is Sudan. There's enough seriousness. Ellie, great. Jonathan, fantastic. Because I don't want to bore you people if you're not serious. So feel absolutely free to log on. Okay, all right. So since there is enough interest, let's begin. Now, expertise in any field, as I said, it doesn't happen overnight. You take years and years of practice, deliberate practice and self-education on all aspects of your art, be it sport. The best basketball player, they just don't play basketball. They probably spend more time in not playing basketball but by going through other trainings as compared to playing basketball. Same is the case with all the other fields. Now, our MoneyWiseSmart, we call it the compounding framework. It rests on 3 pillars. So these are the 3 programs that we have: the Investment Fundamentals program, we have the Multibagger Research Series program, and we have the Option Series program. And actually, Fanliang, I'm not sure if you have the results of the poll. I think there are many of us subscribed. Many of the attendees are already subscribers to one or more of our programs, but we have, yeah, so quite a few of you are already subscribers. That's good to see. So, this is, I'm sorry, guys. Sorry, please bear with me. That was a fat finger. All right, you can see my screen?
Yep.
All right. So these are the 3 pillars of our compounding framework. Now we start with the Multibagger Research Series. This is a deep dive into the high quality businesses that can potentially become multibaggers. So this is our research platform. The Multibagger Research Series solves your problems if you are busy, if you lack the time to research investments, if you have had poor experiences investing on other people's stock ideas or advice, if you are looking for reliable framework for researching high quality businesses, and of course, if you are aware of the problems that you have, unlike my froggy friend who unfortunately is not even aware of what he's leaving on the table. Now, it's very easy to just go and look for stock ideas or advice from elsewhere. It's easy to borrow other people's ideas, but you can never borrow other people's convictions. So unless you deeply understand the business, it's very difficult for you to remain calm when you see that the share price is dropping significantly. You are wondering, why is everybody selling? So that's where real conviction comes into play. Now, the businesses typically that we research, they have the following characteristics. They all generate very high returns on capital, run by very high quality CEOs. They have secular growth tailwinds, enjoy very large total addressable markets and growth runways, and they all enjoy strong moats, and they are typically asset-light businesses, capital light, and they have exponential growth characteristics. These are the kind of businesses that we like researching. So we basically, through Multibagger Research Series, MRS in short, we help you to take back full control of your investment portfolio and stop incurring the expensive leakages in form of expensive fees for external advice. The Multibagger Research Series is hosted on the Teachable platform. It's a very extensive library of over 175 videos. Each company that we take up, we break up our research into several different sections. We start with a business overview. We find out how the business is making money. We have a section on the moats of the business, the competitive advantage. We spend a lot of time researching the competitive environment. We then spend time researching the management compensation, because for us, high quality management is extremely important. High quality management with integrity. We then look at the risks, and only then we dig into the financial statements. Extensively, we look at the financial statements. We even try and normalize the financial statements. For example, there might be businesses which are loss-making, but maybe they're loss-making, but optical loss. For example, Upwork. If you just look at Upwork's financial statement, you might think, oh, this is a loss-making business. But we look under the bonnet. We realize that Upwork spends a huge percentage of their revenues in sales and marketing and R&D expenses, which are basically similar to growth capex. So it's loss-making because they just decide to expense everything, and that's the reason the share prices, the earnings are depressed. So we look at all these factors under the microscope, and then we do a rough valuation of the business. We even do a stress testing. For example, last year when COVID hit, we did a stress testing for each of our business, and Fandyang just asked this question to himself, that which of these businesses will survive if they just stop generating any revenues for so many months, and will they be able to meet their obligations? And thankfully, each of our business came out with flying colors. So only after doing this research, then we see if the business is available at a suitable price. And then sometimes we patiently wait, maybe even for years. And there have been cases where the buying opportunity has come to us after 2 years, but so be it, when you're a long-term business owner. So MRS basically is like a concierge service which helps you to become a long-term business owner. Either you can choose to own these businesses themselves, or you can use the same framework to go and analyze other businesses. Now, the value that we have packed in this multi-bagger research series on a very conservative basis is $9,000 US, and this is broken up into annual subscriptions. Then we come to our investing fundamentals program, and that is targeted towards DIY investors. Investing fundamentals program teaches you how to find multi-bagger investments, grow your wealth. Sorry, guys. Again, my computer gave some problem. Please bear with me, guys. All righty. So by the end of the investing fundamentals course, this is, by the way, a lifetime subscription, unlike the multi-bagger research series, and it's completely self-paced. So by the end of the course, you will learn how to identify and analyze multi-baggers, understand the value of your investments as opposed to the stock price, stop selling only at a small profit, because you would learn how to think like a long-term business owner. Stop selling out of fear when the world is falling. Avoid businesses which destroy wealth, because we teach you how to look for red flags, how to look for risks. And most importantly, sleep like a baby while your business makes you wealthy. Now, this is also hosted on the Teachable platform. You have a lifetime access to a growing library of over 90 videos. And I can very confidently say, and this is based on feedback which some of you, our subscribers who have attended other programs, have given us, and compared to programs from other parts of the world, this is one of the most exhaustive and most in-depth program on investing that you can find at this price level. Now, the conservative value of the investing fundamentals program that we have packed is USD $5,000, and this is for a lifetime access. And then we have our option series program. Many of you are subscribers of this program. Option series program, in short, teaches you how to generate cash flows when you need it the most. In option series, you learn how to use options float to fund your investment portfolio, strategies to generate cash flows to boost your returns, position yourself to acquire more shares of your chosen businesses at your desired price, generate an attractive yield on the cash that is waiting to be deployed and which otherwise is earning you a whopping 0.005% interest in your bank account, and We also teach some shorter term option strategies, which can potentially generate explosive profits by risking very little capital. Now, the most important uniqueness about our option series program is that this is not a trading course. A lot of people think the moment they hear options, they kind of, immediately use the term options trading. But what we teach has got absolutely nothing to do with trading. We are not short-term traders. This is a program which is completely aligned and integrated with long-term investing. So if you are only interested in a short-term trading program, this is not for you. Our program sits on the fundamental bedrock of time value of money, which we talked about. And we use options exactly the same way Mr. Buffett uses options, which we touched upon, like an insurance business. Again, the option series program is a lifetime subscription and has a growing library of more than 150 videos. And the best part is every month end, we have a month end tutorial, which our subscribers absolutely love, and they are recorded and they are added to the program. So the number of modules, they keep growing, and you can see we cover everything under the sun. So just because it's options doesn't mean we stop at options. You can see on the screen, we even talked about taxes and other concepts which are in some way related. Now, this handsome man here, I'm not sure whether Vejo is here. So he is one of our subscribers, and just take a moment to read what he has to say about our program while I take a sip of water. My throat is dry.
Yep, Wejo is here.
Oh, okay. Yeah, Vejo, thanks for this, amazing words. I mean, it absolutely made my day, and very happy for you. In fact, I highlighted this section where he mentioned that I managed to recover the initial course fees within a short period of time. And we are very happy to say that this is the case with majority of our subscribers. And when we receive these messages, it absolutely makes our day. Our products are not discount products. This is not a discount shop. But we know that the value we offer is far more than what we charge. And this is a testament, so thanks, Vejo. Very happy for you. So our option series program, the value that we have packed is USD $20,000. And this again is for a lifetime access. And apart from that, our programs come with a free bonus, which is we have live option series Zoom month-end tutorials. These tutorials go on for, sometimes 3 hours, 4 hours. Basically, we ensure that every single question is answered. We invite case studies where our subscribers submit their actual positions, which we analyze, dissect, and help to guide them. Sometimes we, tell them if there's a problem with the position or what are the better ways of doing it. So we definitely provide guidance in position adjustments. Of course, we cannot provide recommendation. We cannot tell them go and do this, but we show them in a very educational manner. We also, our subscribers enjoy preferential pricing for all other programs. And from time to time, we conduct workshops. Like earlier this year in March, we conducted that 3-day workshop only meant for absolute beginners who did not know anything about option. It was a very elaborate program. And as you saw from, what some of our subscribers say, that this really helped them to graduate to the next level. And it was very easy for them to track the rest. And the recording of this is available to all our option series subscribers. So the value is $6,000, but this we throw in as a free bonus. Now, the testimonials that we do, I mean, these are not just, cursory testimonials. You can see from the kind of comments that we receive from our subscribers, and these are the actual poll ratings. Tutorial after tutorial after tutorial, we maintain the same consistent high rating. Majority, almost 90% of the attendees rate us 5 stars, and we do get some 4 stars, which keep us on our toes. We are not perfect, but this is what tells us, and we reach out to some of these people to find out what is it that we need to do to improve ourselves. So you can see, fantastic session. Love you guys. This is absolutely amazing stuff. So we add a lot of value in our tutorials. Now, we talked about the value, and we have this philosophy in our company that we like to offer a disproportionate amount of value compared to the price that we charge. So if we add up the total value of our 3 offerings, it amounts to $40,000, but we have priced it at an unbelievable attractive price. Our multi-bagger research series is priced at a subscription, annual subscription was just $399. Our option series diamond program, this is the top tier option series program, priced at just $3,499 for a lifetime subscription. And our investing fundamentals program, the market price is just $1,999. Now, if someone purchases them individually, it adds up to $5,897. But we believe that these programs complement each other, and they, as I showed you, our compounding framework involves all these 3 pillars. So that's why we want to make it attractive when it is purchased as a package. So we introduced the total access package where instead of $5,899, we offer everything. That is everything from the MoneyWiseSmart that we have to offer. We offer this total access package for $3,999. Now, I know you guys have showed a lot of commitment, dropping everything else and staying back. You guys said you're really serious. So we want to show our commitment to all action takers. And for the duration of this webinar, this price is not available elsewhere. We are offering a special discounted price of USD 3,499 for this gift box containing the entire total access package. So this is directly aligned with our philosophy of, pricing our products for our serious subscribers at less than 10% of the value that we offer. So I request Fan Liang to share the link. This is valid only during this webinar. So I would encourage you to take full advantage of it, of this particular offer. You managed to straight shave off $500 over and above the huge discounted price of going for this package as one unit. Now, I would leave Chen Chong's. I saw Chen Chong is also here. Now, this is again a very special testimonial. I would ask you to take a moment and read this testimonial. Chen Chong has subscribed to more than one of our programs. He is a subscriber to both investing fundamentals and the option series diamond level. And I would like to congratulate Chen Chong because, during the COVID lockdown, he made absolutely the most of it and took full advantage of this program. And just read what he has to say. Now, I would again like to highlight the last couple of paragraphs. Synergy is the word I can describe for the above 2 modules combined. Knowing the value of the company and then using it to price my option strategy End result is getting more of a company at great prices and getting paid while waiting. Amazing. And that is exactly that insurance business thinking, which that's the reason why I started the case studies with the insurance business. Thank you, MoneyWiseSmart. I have just upgraded myself through your program. Very happy to know that, Chen Chong. The value I gain is multiple times the fees I paid, and the value keeps compounding. Absolutely. And here I must say that, you know what? We don't, the entire credit is not ours. The lion's share of the credit actually goes to Chen Chong, because look at his progress bar. Now it is this, the commitment that, you know, people like Chen Chong show. It just can't happen that he doesn't see the results, because he has showed the commitment. He attends the tutorials. He whenever he has a doubt, he asks it in the forum, and you know, the results are showing. So very happy with your progress, Chen Chong. I mean, you know, this is the kind of feather in our cap that we like to wear in MoneyWiseSmart. Okay, so there, we appreciate that there might be some subscribers who, you know, who are new, and they would like to start with the investing fundamentals and MRS, and maybe delay getting into options. So we have created a special package just for them. This is based on some feedback that we have received. So this particular package, which includes just the investing fundamentals and multi-bagger research series, plus we have the free MRS meetups, which we do every quarter. The value is $14,000, but the market price of this bundle is just $2,398. That is for year one. And of course, year two onwards, the multi-bagger research series subscription will be payable, because the MRS is a subscription product. And our prices gradually catch up with the value that we offer. When we launched our products last year, the prices were significantly lower. But you know, I have always said that, you know, the prices always keep going up because we keep enhancing the values. Just like the intrinsic value of a business keeps going up over time, same happens with the price of our product, because the intrinsic value of our program also keeps going up over time. Now, here also, I would like to show our appreciation for your commitment. And just during this webinar, instead of 2,399, this MRS plus IF package, we are offering for a deep discount of just 1,899 for year one, and year two onwards, it's just 399. Now, essentially, what I'm offering you is for a price of less than your daily commute and your daily COPC, you get to have access to one of the most elaborate and extensive investment education frameworks that is out there. Now, this is just how the flow works. So when you click on the link which Fan Liang would have shared for this package, as well as for the TAP package, you will just see investing fundamentals, and you'll just see enroll in the course, $100 off. But when you come to the thank you page, the MRS is thrown in for free. So the entire MRS, which is almost $400, is also available to you for free. The same is the case with the TAP bundle. When you click on the link, you will just see the bundle with investing fundamentals and option series. But not to worry, the MRS is available for free in the thank you page. And by the way, I know this is a common question for our existing subscribers who have subscribed to, you know, just one product or two. I encourage you to take advantage of this offer to upgrade, but don't worry, you're not going to be double charged. If you upgrade to total access package today, whatever you have subscribed to in the past will be completely refunded to you. So Fan Liang will process the refund directly to you. And same with this particular upgrade. So if you're already an MRS subscriber, and if you want to upgrade to investing fundamentals, the same principle would apply. Now, I understand that the investing fundamentals was the first program that we launched. So when we launched, the price of our investing fundamentals program was a lot less. It was a few $100s. So some of you would have, taken advantage of that launch price. Now, obviously, the MRS, the market price today is just $399. So for those of you who are early subscribers, it would not make sense for you to go for this package because the current market price of the package is $18.99. So if you want to have access to MRS, you can just separately go and subscribe to the MRS subscription. Fan Liang will share the link, or go for the total access package because that's a fantastic offer. And just to ensure that you have absolutely no risk in your purchase is 100% backed by a 3-day money back guarantee. We feel 3 days is a good enough time for you to go through purchase, go through the program. And if for whatever reason you think that this is not for you, absolutely not a problem. Just let us know, and we offer a no questions asked money back guarantee. So we take the entire risk away from your purchase, your investment into your self-education. This is again two of our subscribers to the Multibagger Research Series program. YP is from Singapore, and Connor is one of our youngest, probably the youngest subscriber. He's just 21 years old and very committed, has gone through, he has, his progress report also looks very similar to Chen Chong's progress report. And, I must say that very impressed with the commitment that Connor has shown. And it shows, in fact, sometime back, Connor was researching this business called Shopify, and the kind of quality that he produced. In fact, at some point of time, we will share his research with the community. We were absolutely blown away. And that absolutely made our day, that not only has he, and he's a student, he's still a student, by the way, he's graduating just coming May. He lives in Scotland. So juggling with his studies, and it's quite, he's also studying actuarial science. So with that, the kind of commitment that he shows, it's amazing. Doesn't miss a single tutorial, has gone through the program, learned it, and has started applying it. And I'm a huge believer of compounding, and this is how a young billionaire looks. Billionaire with a cap. I have no doubt in my mind that in his lifetime, he will end up being extremely wealthy. And these are some of our subscribers from different parts of the world. Clinton is from Canada. Again, one of the smartest, very inquisitive investor, doesn't take anything at face value, keeps us on our toes with his questions, and we love it. We love working hard for committed subscribers like this. Dia is from Singapore, again, very committed. Derek is from Gillette, Wyoming, US. Derek, somehow I was under the impression he's from Texas. But anyway, again, doesn't matter what time zone it is, there hasn't been a single tutorial that Derek hasn't attended. And the results show. So guys, that brings me to the end of the session. We managed to stick to the time we said we will, less than 2.5 hours. So questions now. And feel free to unmute yourself and ask your questions. I'll be more than glad to answer. And Fan Liang, if there's anything in the chat, please let me know. Or you can
Yep. So my chat has some problems just now, so I might have missed some. But if you have any questions, feel free to raise them again. And so far, I have private messages.
Okay.
So,
by the way, Fan Liang, before we go into the questions, yes, we have someone with us, Lance Quek. In fact, we are very thankful to him. In our early days, when we could not afford a Zoom account, actually, that's not right. We were just being cheap. We could afford, but we borrowed Lance his Zoom membership, and our initial tutorials, he used to set it up. So Lance, thanks a lot. Very grateful to you for that. And our subscribers also. All right. Perry, thank you for your kind words. Perry says, I highly recommend the option series, the most impactful and in-depth understanding of options integrated with understanding businesses. Thank you, Perry. Really appreciate it. All right. So Fan Liang, you don't have your chat, is it? So let me see.
Yep. And yeah, but I've got private messages. And in the meantime, also, we would like to thank Apua Jen. He has just left. He texted me. He just bought total access package right after you disclose the deal, but he has to go now, so he has left this
excellent
meeting.
Thank you, Apu. I mean, it gives me great pleasure. I call him Apu. I know him for over 23 years. We used to be colleagues earlier in a company, and then he moved to Singapore. He just retired from, he's a senior managing director. He was a senior managing director with Standard Chartered, spent time in Africa, Bangladesh, India, and I think now he's coming back to Singapore, wanting to become a full-time investor. And it gives us great honor to help him in his investing journey. Okay, so.
Yep, I have a private question asking, there are 3 courses under Total Access program, and there are so many modules or videos. Like how long do we need to spend to go through them? How many hours a day or something?
Okay, that's a great question, which a lot of people have. Guys, all our programs, they are completely self-paced. So this is not a sprint. And as there is a reason why even the case studies that we show a 50-year time period, because here the learning, the education that we are providing, it is education for life. So the short answer is, you choose your pace. Even if you have 15-20 minutes a day, that's more than enough. Even if while okay, now the offices are closed, you're probably working from home, but even if you're traveling in an MRT and you can listen to the videos on your hand phone, 15-20 minutes, half an hour a day, that is more than enough. If you can spend more time, that's great. But I would actually advise everybody against trying to go too fast. Just take your time, attend the tutorials, ask questions, apply the same principles, open a paper trading account, and practice the strategies. So it's not as if you have to finish everything in 6 months and then you start. No, you have lifetime access, which means you have lifetime access to us as well. So I would like to see you guys around 5 years from now, 10 years from now, 15, 20 years from now. We are all part of the same community. When you have, if you're not a family man or a woman yet, and when you start your family, I want, your children to join our community. So that is how long-term we think. So it's completely self-paced.
Hey, Rupam, do you mind if I know this may sound a little like a stupid question, right? So
no question is stupid question. If you can please first identify yourself, because I can't see you. Okay, actually, so let me stop the screen sharing so that I can see some of you.
So this is Lance. Just wanted to ask, right? Because I do have a thing called swim account, right? That is individual. Now I'm trying to shift all my positions for tax purposes into a company,
Yes.
right? So that means opening an interactive brokers account using that company. But now the thing is, I'm not sure how do I transfer those positions that I have on my personal account into that company's account.
Lance, that's very difficult to do. It is not an impossible thing to do, but talk to interactive brokers, and I'm very confident that the first response you'll get is no, they don't do third-party transfers. So the beneficiary and the receiver has to be the same person. However, there are ways. You have to establish to them that you are the owner, because currently the stocks are in your name, your personal name, I'm assuming, and you have to establish, they will need documents and all those things to establish that you are the owner of the company. So, I know it is possible, but I also know that it's very difficult. I don't know exactly how, so you need to check with them.
Sure, thanks.
Any other questions, guys?
Yep,
Sharon, I see a question. Sharon says, does anyone have the where are the customers your PDF? Actually, I do, Sharon. Let me now the thing is, I'm not sure whether in the Zoom chat can we share PDFs. I don't know, but Sharon, I have it, and I will give it to you.
Yep. And Rupam, there's also another question.
Yes.
Sent privately to me. So someone was asking, she is interested in the total access package, but she needs time to think about it, given that it's a combination of 3 courses, a lot of things to go through. And she's asking whether if she doesn't buy now, would we have similar promotions in the future for the TAP?
Now, the thing is, there is one thing which we do not do as a matter of principle, which is that, look, after today, there will be the people who will be purchasing the total access package, they will be purchasing at market price. So for us, this is fairness is very important to us. Even if one person purchases it for 3,999, it will be extremely unfair for us to then go and again offer a promotion, offering it at a price less than 3,999. So this is one thing which we have been extremely consistent, and that is how we plan to keep it. It is, it is in a very, very unlikely scenario. Let's say if no one purchases at 3,999, and let's say next month we are again doing a promotion, we decide to offer it, but it's extremely, extremely unlikely, because we have subscribers coming in all the time, and we will not be unfair to any subscriber. So see, frankly, I feel that the price of our total access package of 3,999 for those who have gone through the program would support me there. It's an extremely attractive price. I am not flippant when I say that our options program is absolutely the best in the world at this price level. It's an amazing price level. So you are not really losing anything compared to the value that you get, and this is a lifetime access. But this offer is, just to show the appreciation to, those of you who are taking action right away. They are the decision makers, and at the end of the day, they get rewarded. So that is what this package is about.
Yep. There are a few more purchases, people who have purchased, and I just quickly see the chat. I think Valerie Lim is here. So Valerie, congratulations and welcome to our community. And I think you have previously purchased one of our courses, and then now it's your second time purchasing other courses.
That's fantastic. We absolutely love repeat purchasers. So thanks for placing the trust on us. We really appreciate having you, Valerie. Any other questions? Guys, feel free to unmute. Any question regarding the topics that we covered. It doesn't have to be necessarily anything to do with sale or anything else. I'm just taking a break from wearing my specs. So it's easier for me if you unmute yourself and ask the question. Okay, Derek says he has lived in Texas for 9 years, but originally from Wyoming. Oh, now in Belize. Wow, amazing, Derek. Look, this is the commitment. He's in Belize, but he has joined us even from there. So great to have such absolutely committed subscribers.
Rupam, there's another question asking, what kind of support do we provide? Like if he has questions, like how to go about it.
Okay, Connor, can I request you to unmute yourself and answer this question? Because what kind of support we provide? Hey, of course, I will say we provide great support, but why don't I request one of our subscribers to answer this question of what kind of support we provide? And Connor, be absolutely honest. If you think we suck, say that.
Well, being a subscriber, you get access to the Facebook groups, the Facebook group. And basically, after each video, there's always some sort of link that takes you towards a chat that's designated towards discussions that are related to the course videos. So not only do you benefit from Rupam and Funliang discussing and answering questions, you also benefit from everyone else's discussions. But the fact that Rupam and Funliang are pretty much, you have access to them 24/7, pester them with messages, with questions, and they always respond very, very quickly. And it's not just a short answer. It's not just a sentence or two. I mean, some of the messages send you are incredible. They're lessons in themselves. They go paragraphs, they go pages, and it's all interesting stuff. And they're not there just to tell you this is the answer, this is what we think. They really go into some amount of depth to help you understand and get it to yourself, let you understand these concepts yourself. So, not long ago, I'd asked Rupam this question in the Facebook group, and he responded to me with a bunch of questions, because he knew that I would be able to get these concepts. I've been through the videos, and after hearing just a few things back from him, it was all those light bulb moments that I pretty much receive every single day through MoneyWiseSmart. Having access to them, it's unbelievable, that the knowledge I have and how much they share, and having access to them all the time. I've never came across anything like it. I'm doing an actuarial science degree, and my lectures are far, far harder to get access to. And even at that, they're not as committed as these guys. That's all I can say. That's as much as I can put it. It's world class, in my opinion.
Thank you very much, Connor. Really appreciated your faith on us. Thank you.
Anytime. In my opinion, is that you deserve these kind words.
Thank you so much.
The values that you offer is unbelievable.
Very, very touched. Very touched. Fanlian, I can see one question that Sebastian has. This is about the StoneCo presentation. Would you like to take it? Can you see it? Or
yeah, I can see it now.
Okay.
Yeah, and thanks, Connor, for the kind words. So on Sebastian's questions, Sebastian is asking on StoneCo, the total payment value, which is a TPV of StoneCo, is much lower than a traditional competitor, Sailor, which is pretty big in Brazil. But while StoneCo's valuation is 14 times that of Sailor, Sailor has like partnerships on WhatsApp, for digital wallet? Don't we think that Sailor is much undervalued? So on these questions, Sebastian, I would have to say we haven't looked in detail into Sailor, but what we can say is Sailor is part of the group that used to dominate the industry and is one of the traditional players. And you can see how different is in their efficiencies, in their profitability, comparing between the traditional players with the modern players like StoneCo and Park Seguro is also another one. And there will be more coming up in the future given that the market size is so big. So when we look at business, I can't comment on whether Sailor is undervalued or not now, because I haven't looked into it in any valuation. But as we said right at the front of this session, when we look at companies, we are thinking about owning a company for many, many years, for long-term, like a long-term business owner. And what comes first is the quality. So whether we want to invest in a more modern player, much more efficient player versus a traditional player, which has been protected by the government, so they didn't have to be efficient. They can overcharge, they can under supply or under deliver. Then to change it, you need to have a complete change in culture. A lot of things need to happen. So in terms of quality, we would definitely go for the modern players, the good ones run by good management, who wanted to revamp this whole inefficiency and provide the best values to the customers at a win-win situation for both the customers, the company, and the shareholders. And StoneCo is one of them. So that's why we look into StoneCo. At some point, we'll look into Park Seguro, another modern player. We have looked into it briefly, but not in depth yet. So on Sailor, I can't comment too much on his valuation right now.
Just one thing to add, Sebastian. When we are researching a business, for us, it's extremely important to ensure that the business is customer friendly, customer focused. In fact, all our businesses are, and that's a very, very important consideration. CLO belongs to the genre of businesses which basically have taken customers for granted for a very long time. I mean, that is exactly what happened with traditional banks, and that is the reason why suddenly you see that they have all woken up, but it's it's too late because all these modern fintech companies are eating their lunch. So if we look at how StoneCo thinks of their customers, I mean, their whole onboarding process, using their green angels, I mean, it was unthinkable for someone like CLO. So yes, their TPV volume might be much higher, but when we are investing in a business, we are also looking at the future, and just from that customer orientation point of view, StoneCo is much more attractive to us. For the very same reason, a business like Amazon, their absolute obsession with customers, is successful. Companies like Amazon, Costco, I mean, very similarly, StoneCo falls in that category.
Yeah,
Lance, unfortunately, we know nothing about CrowdStrike or Zscaler. I mean, I think it is a bit outside our circle of competence, so can't comment really.
Yep, and I just see another person who is still online, who has subscribed to our Multibagger Research Series and Investing Fundamentals too. So Kim, yeah, thanks Kim. We've known each other for quite some time. I think Rupam even longer. And she previously purchased our OS. Now she has bought into everything. So thanks Kim and welcome.
Thank you, Kim. Very, very privileged to have you as part of the team. And I must say that Kim has played a very special role in our investing journey, because she very kindly opened up her home for us. That used to be our meeting point for our mastermind discussions, and we used to sit there and we used to discuss these companies. And Kim absolutely used to forbid us from, getting food from outside, because she used to organize the food, make the food. So, and we had some very amazing time at her place. I think it's way overdue. Another, just for old time's sake, another mastermind. So very privileged to have you now as our total access package. And of course, we have to come and see your new home. Kim, by the way, has just is a proud owner now of an amazing apartment in one of the most prime areas in Singapore with a beautiful sea view and stuff like that. So have to come and, maybe our next mastermind session, we will do it there. Thank you, Kim.
Yeah, thanks, Kim. And I just want to circle back to Sebastian because I forgot to answer some other parts of his question, where regarding Cielo having partnership with WhatsApp for digital wallet, I think there's no reason why StoneCo can't, or any other modern players can't do so too, especially when their technology platforms are much better, much more modern, built from scratch to cater for a digital world, where you see so many people actually want to partner with StoneCo, like Links doing e-commerce software, and then Grupo Global to partner with them to target the micro merchants. All these are very big players in their respective fields, and they all want to partner with StoneCo. And StoneCo also recently partnered with a digital bank, and they're going to do a lot of exciting stuff going forward. And I'm pretty sure they will be doing a lot more partnerships in the future. There's no reason why they can't do. And the other part about StoneCo is that, as Rupa mentioned just now, it's not just about the business is good, but the management has been very friendly. That's, you can go to sleep comfortably, peacefully, knowing that this management care for the shareholders. Where whenever there's some problem coming up, like the recent credit issue where we discussed earlier in this session, they didn't have to talk about them, but they were the first to disclose to the market that, oh, there's this issue, this is how we think about it, let's be transparent, tell you everything before their quarterly earnings, so that no one gets shocked. Like, as shareholders, we are well informed by the management. If the management think is an important issue that everyone should know, for us to make informed decision, they will talk about it at the first place to us. So that's the kind of management that I really like, that we really like, because you feel safe. It's like, if you own a company, you're almost sleeping with them every night until you sell them away, and you want to go into bed with good management that cares about you.
Management integrity is absolutely top notch. I mean, StoneCo's management quality, you have to just listen to an earnings call to get an idea. Thiago, their CEO, he's a very young guy. He's what, 32 now?
He's 31. I remember it because he's just 1 year older than me.
Oh, okay. 31. And their chief strategy officer, Leah Matos, amazing. I mean, you just have to listen to them, the earnestness with which they think about the business, they answer the questions.
Yeah, and we talk about a lot of these points about their management in our Multibagger Research Series. So people who have gone through those, they will have known quite a lot of points about this management of different companies that we own.
Yeah, Lance, thoughts on Kopang? Our only thought is it ticks the boxes to go into our 2 research lists. So we will get to Kopang, the South Korean Amazon. So yeah, yep. we will get to it.
Thank you.
Yeah. All right. Any other question? Sebastian says, I agree and see that management is open and their experience in payments industry. I see the huge advantage of local hubs of StoneCo. For me, it's difficult to choose which player to win 20 years from now. StoneCo packs from current players. In my opinion, there won't be one winner. Yeah, it's not going to be a winner take all business. In fact, all of them can win because they are changing the whole paradigm of how business used to be done. So it's not going to be a winner take all.
Yeah, and I would also add that
I don't think, Sebastian, we have a slight difference in opinion about the valuation. It used to be overvalued, but at the current level, I think it's quite attractive. But then suit yourself. I mean, valuation is a personal perspective.
Yep, agreed. And I would just like to add on also that in investing, how we see it, as we mentioned earlier in this session, is that the future is inherently uncertain. Those who think that the future is very certain, I would say, in my humble opinion, is probably just wishful thinking. So, but in that context, we can still invest and try to achieve a good investment return over years, because we have a portfolio of companies and we are aware that future is uncertain, and there are ways to structure our portfolio such that even if some of the companies go totally to zero, we will still come up pretty well. And we cover this in very detail in our investing fundamentals courses, where in tutorials, we always talk about this kind of portfolio management or structure strategy to compound wealth for the long term in the midst of uncertainty.
Actually, Fanliang, since you brought this, I did not present those slides, but it might make sense to just, talk a bit about the companies that we have covered in our MRS. Can you see the screen?
Yep.
Okay, so Fanliang, you want to talk about these slides, or I can just quickly run through them? So these are the companies that we have covered. So in 2019, we researched 3 companies. In 2020, we released 6, and 2021, we have released 5. So we are looking at JD Logistics and JD Health because, we want to kind of do a deep dive in the entire JD group. And, for us, researching a company means, reading like literally thousands of pages. I mean, all these companies, they have prospectus worth some, 500, 600 pages. And we go through them, we go through all the transcripts and do absolute detailed research. Now, one thing which we have mentioned in the past also, it's there in the FAQ. Now, we are not a stock recommendation service. So we never come out and say that, oh, you know what, we will release one company every month. There might be periods where, long periods of time where we don't add a new idea just because we don't find anything interesting. So this is exactly, thinking like a long-term business owner. And there might be times like in 2020 where we released quite a few interesting businesses. Now, our businesses are all high growth companies with an average revenue CAGR of 30%. Now, some of them have clocked much more in terms of revenue, and this is from 2016 to 2020. But we, at a portfolio level, we look at a revenue CAGR of 30%. This is the gross profit CAGR, which again is 30%. This is how the total returns have been. Now the bars are looking small because one of them, Evolution, this is big. So this is, to scale. So Evolution has been a 10 bagger since 1st January 2018. RDN has been a 5 bagger, but the overall portfolio average has been 228%, which is about a 2.5 bagger. And in CAGR terms, this is the portfolio has generated an average return of about 37% CAGR. Now, there have been a couple of small negatives, but again, I mean, we are long-term owners. So we don't believe in any rebalancing, and we just let the winners run. So this is how the portfolio is looking like. And, Process has been the latest addition. We feel it's grossly undervalued. JD, again, I mean, we are just deepening our research by looking at JD Logistics, JD Health. For us, JD has been already, I think 3.54 bagger. And recently also JD, for those of you who are not scared of this China scare, and who are ready to look at long term. Sometime back, JD offered a very good entry point again. But anyway, our purchase in JD happened long time back. So this is what the portfolio currently looks like.
Yep, Rupam, can you just stay on this chart? Yep.
Yep.
Yep. So I would also just like to add one comment, just relating to Sebastian's point, where I think if we own a set of 10 good companies around there, after many years, it is very likely that the returns for each company will be very diverse. Probably something that you see here, or even more extreme, where you get some losers that just didn't perform as expected. And then you also get some companies where you thought it won't perform that well, but in the end, due to various opportunities or optionalities, it actually become one of your biggest winner. And for us retail investors, I would say identifying these companies are not the hardest part. I think if you think about Amazon, a lot of people know it's good, but how many people actually have benefited from that few hundred times, or I don't know how many times, or even 1,000 times since IPO? Because throughout this journey, there will be a lot of up and downs. And I think there was one point where Amazon was down 80 or 90%. Imagine Jeff Bezos, his net worth just got cut 80 to 90%, but he said he didn't care. But that's because he understands his company very well. He was looking at his internal statistics, his internal management report that, oh, my business is doing so well. I don't care about the market. But for us retail investors, I think the struggle is on psychology, whether someone can actually hold, say, Adyen for the next 20 years. There will be a lot of bad things happening, share price crashing, market crashing, a lot of scare, maybe even a Netherlands scare. Adyen is based in Netherlands. So for us to be able to hold through this, I think one very key important point is the psychology, and to have conviction, like what Rupam said, we need to have a strong understanding of the business. That's why we know what is right, what is not wrong. Sorry, what is right and what is wrong. What is just rumors, what doesn't affect the company's long-term fundamentals. What are the things that affect short-term fundamentals, like what's happening to StoneCo now? And it's only with that kind of understanding, which is why we structured our multi-bagger research series like this, that people can get more information given their lack of time to research, that through this, hopefully, everyone can make their own informed decision while being able to withstand all this volatility better.
Great points. Okay, Sebastian, yeah, you're right. Nick Sleep. In fact, he's also one person that we follow. I was very influenced by after reading his letters.
Yeah, for those of you who do know, I think Nick Sleep runs a fund, and his fund has performed amazingly well. And probably as implied by his name, what he does is, in a way, he just slept through his investment, a few key investments. There are, I think, 3 investments that actually drove all those returns. I mean, he is always constantly traveling globally to look out for new companies. But after, I think, 10 to 20 years, it's only 3 companies that actually made most of his return, where he managed to sleep through all of it, doing nothing, which is also not an easy thing to do. Imagine a lot of people would have sold themselves.
Yep. Absolutely right. Okay, do we have any more questions? Otherwise, we can wrap up the session.
Yep, I don't see any question, either public or private, to me at this point.
Sebastian, yeah, I agree. The only thing is, the airline industry stocks, they don't tick all the boxes that we look for, and especially after COVID. COVID has thrown up a different kind of risk, which a lot of people were not even aware of. So it might be interesting, but we won't touch the airline industry,
Yep, and I'm a Malaysian, so I know AirAsia. I mean, AirAsia is from Malaysia. And I would say, even though it looks attractive at a price point, but like as you have pointed, debt is very high. I mean, there are a lot of investments that can make you money, but whether if you buy into this, can you sleep comfortably at night if, say, COVID suddenly goes even more serious, countries go into lockdown, and Tony Fernandez, even though he he has a lot of connections. Somehow the company can't raise a lot of money anymore in the future. Then there's always that risk that because of this debt, at least for me, I won't be able to sleep soundly at night if I put a large amount. That's why even though potentially it can make money, is the kind of risk reward dynamics whether you personally want to get into. And for us, is a no-no.
And look, the thing is, yeah, I mean, they can decide to enter whatever business, but right now, do we have any rational way of estimating that they will be successful? I mean, they decided to enter the food delivery business in Singapore. I mean, I don't know if there is anyone here who has tried ordering their home delivery from AirAsia. I mean, in Singapore, there are these three companies: Grab, Deliveroo, and Food Panda. They rule that space. So entering a business doesn't guarantee success, because nowadays barrier to entry is low. It's the barrier to success which is the challenging part. So I mean, do they have any core competence in in fintech? Just having a database? Yeah, a lot of companies have large databases. That doesn't guarantee their success. So it's something we don't know. We only have to see in future.
Yep, totally agree with Sebastian that, I mean, even if it's not now, maybe it might be an interesting company to watch in the future after they manage to execute. And I would just like to quickly share, I think it might not be totally applicable to AirAsia because I haven't studied it well enough. But one lesson or mistake that I've learned in the past is that when I just first start out investing, I tend to buy into all these, I shouldn't say all these because AirAsia might not be one of it, but I tend to be attracted to companies that say, oh, they have all these plans, ABC will get us to like crazy, we'll dominate the whole world. And this, I would call them the story stocks. Their stories sound amazing. Like if you just listen to the story without the name of the company, maybe you'll buy into it. And for me, I bought into Singapore Post in Singapore, which is a traditional meal service company, has national connections in Singapore. And they were doing all this revamp where they already have the logistics fulfillment structure to deliver the normal slow meal. And then they wanted, e-commerce was booming. They wanted to go into e-commerce. And then they got in a consultant, McKinsey ex-consultant lead from Germany. I forgot his name, but last name is Wolfgang. And then that consultant brought in a lot of senior management from Silicon Valley, from McKinsey, from the big three consultancy. Everyone, like, all the story just sounds perfect. And then things happen. Things didn't get executed, but I bought it earlier when they were just painting all these stories without observing whether they actually executed. And what a lesson I learned is that if the story is so good, it's going to last for 10 years, then even if you're a bit slow to the trend, then why not just wait for it to execute a bit first? When there's more certainty, it's still not going to be too late to the trend. Maybe you might be earning less returns compared to the first guy who jumped on the trend without knowing whether the trend is going really up or coming to a cliff. But at least you're much safer. And Warren Buffett always say, first rule of investing is never to lose money, and second rule is to look back at the first rule. Yeah, so maybe it might be applicable to Asia or not, but this is just something that I thought might be interesting to share.
And Fanlia, you make a very interesting point. The thing is, if a business actually dominates or actually does very well for the next, let's say, couple of decades, I mean, by not investing now, if you build that conviction, build that certainty, and let's say invest after 5 years, I mean, at the end of the day, it is the maximizing of return on capital. So if today I have a capital of $100, that capital, I'm better off deploying that capital somewhere which is going to give me a higher probability, 15% or 20% return today. So let it compound for 5-6 years till I get more conviction in this business, and then I can maybe channel some of the capital into this business. So the compounding doesn't stop. This business does not have to be part of my compounding engine from today. It doesn't matter if I'm buying it today at $50 or if I'm buying it after maybe 5 years for 150, because it is the at that point of time, I'll be happy to buy at the future value, 5-year future value of today's $50. So that is how we think of. So it is not necessary that 5 years down the line, we have to buy it at $50. So that is where the understanding of, time value of money and, compounding it helps. So we are absolutely fine being patient.
Yep. And I would also just add that I think, say in this example, if we only buy it 5 years later, and if we continue to monitor it throughout these 5 years, imagine the kind of information edge that you know about this company compared to other investors who just look at it for just one month or even 1 week, where just by casually monitoring the company over 5 years, maybe we might spot blind spots that we didn't realize earlier, or we might learn new things about the company that makes it very good that we haven't thought about it earlier. And yeah, so there are plenty of time to compound if a company is good. And Monish Parbai always say that and no offense here, or it applies to both gender, female and male. He always says that the mistress always looks more attractive than the wife. And when oftentimes, like maybe we haven't looked at Asia in the past, but because of this COVID price crashing, and then they've pivot into all these new businesses, like we just look into it for, I don't know how long you have looked at it, but I just look at it for a few weeks, and then it just sounds exciting, like attractive, just like a mistress. I'm not saying that I will go for a mistress, but you get the analogy. Yeah. And I would rather slowly observe and let my knowledge about a company compound before I make an informed decision.
Okay. So thank you very much, guys. I see there are no other questions. So it was a great pleasure conducting this webinar. And for our Option Series subscribers, we will see you next week for the month-end tutorial. So remember to submit your case studies, any doubts, any question, and we'll see you soon. If you found this video interesting, then you should definitely join our research platform. It's completely free to join. There are no hidden costs. And that's where we publish our free research on several high quality businesses, which are typically compounders. The link to join is available in the description section below. And I also welcome you to join our Facebook group called the Investment Forum. That's a place where we discuss these high quality businesses with several other DIY serious investors. And you will benefit from the discussion, I'm pretty sure. And if you enjoyed this video, can I please request you to hit the like button and do subscribe to our channel. It does not cost you a penny, but it will really help us with the YouTube algorithm. And we will be able to notify you whenever we are coming up with other interesting videos on company research or other investment concepts. So I'll see you in the next video. Thank you very much for your time.